So hello all my dearest students of South India. I hope you all are doing good and I hope your studies are going on great for your upcoming examination. So today we are going to start with our third target after RTPs and past paper. That is, we are going to compile today mock test papers of past papers and also of May 2024, both the series. Okay. So let us start, and that too in full English, especially for my dearest students of South India. So the very first question over here in the MTP Series 1 November 2022 is on obviously total income. The first question is generally on total income only. So there is an assessee who is engaged in some civil construction business. The assessee wants to compute the total income tax liability, but as per the provisions of 115BAA. So accordingly, you have to be very careful. 115BAA you have to follow over here. Okay. Now the very first thing is the net profit. The net profit is 85 lakhs. Now the first adjustment over here after debiting and crediting of the following items, there is some interest of 3 lakh rupees which is not paid till the due date of filing of return. It is paid after the due date of filing of return. Therefore, this interest will be what? This interest will be disallowed because the loan is taken from a public financial institution. Okay, it is disallowed under 43B. Secondly, you have made some payment to a non-resident towards fees for technical services, but you have not deducted the TDS. You have deducted and paid the TDS in the next year. Again, you have made a mistake. So your 100% expenditure will be disallowed over here under section 40 clause A sub clause 1. Third one is you have paid some 15 lakh rupees as a damages to the government for doing some defect in construction of the flyover. You have got some contract from the government to make a flyover, but you are not able to make it properly, so the government is charging some damages. So it is a penalty, but it is a compensatory penalty. It is not a penal penalty. Remember, compensatory penalty is allowed under the income tax law. Therefore, this is allowed. Next, depreciation you will disallow. Next one is an important adjustment. Mark to market loss. Mark to market loss is generally allowed under section 36 subsection 1 clause 18, but it has to be as per the ICDS. But if it is not as per ICDS, then it is disallowed. Therefore, in this ICDS, it is written that if there is a mark-to-market loss of unsettled derivative contract, then it is not allowed. Therefore, because this mark-to-market loss is of unsettled derivative contract, therefore it will not be allowed under the income tax law. Next one, you are selling some land to your 100% subsidiary, but unfortunately that subsidiary is what? Is a foreign company. Then you will not get the exemption. Exemption under section 47 is available only if you transfer a capital asset to your 100% subsidiary or 100% holding where the recipient is an Indian company. Here it is not Indian company, here it is a foreign company, therefore it is taxable under capital gain. How will you compute the capital gains? This is the profit. First of all, reduce this profit from PGBP. It is not chargeable under PGBP. And then you come to other information. It is written that you have acquired this land in 2015 for 30 lakh rupees. Okay. Now, on that you are making a profit of 10 lakh rupees. But therefore your sale consideration will come to 40 lakh rupees. 30 lakh rupees is your cost, 10 lakh is your profit. Therefore sale consideration is 40 lakhs. But your stamp duty value is 50 lakhs. And the difference between the 40 lakhs and 50 lakhs, that is the sale consideration and the stamp duty value, is more than 110%. Therefore you will take as per section 50C, 50 lakhs as your sale consideration. And your cost as 30 lakhs. You index that cost. Indexation is given to you and compute that. And on that long-term capital gains, you will be chargeable at 20% tax under section 112. Okay. Next one is you are getting some retention money in respect of your contract. Okay. Now, in case of a construction company, they have to follow percentage of completion method. And as per percentage of completion method, retention money is taxable today only. Whenever it is retained, it is taxable under the income tax law. Therefore, it is taxable under PGBP. Don't make any effect of this. Just write a note that retention money is taxable today only as per the percentage completion method. Okay. Next one, you are earning some interest on fixed deposit. Generally, if you earn interest on fixed deposit, it goes under IFOS. But here the objective is not to earn interest. The objective is to get a contract. And for that purpose, you have given a bank guarantee to the government. And because you have given the bank guarantee to the government, you have to make a fixed deposit. And in that fixed deposit, you are getting some interest. Therefore, here the interest is linked to your business activity. I used to say in the class, the interest is inextricably linked to the activity of business. Therefore, this interest will be chargeable under PGBP. Therefore, do not give any effect. It is chargeable under PGBP only. Okay. Next one, the assessee has invested some money in real estate investment trust. From there, the assessee is getting two portions. First, assessee is getting short-term capital gains. On that short-term capital gains, assessee will not pay tax because on short-term capital gains, REIT pays tax. So REIT will pay tax on that at MMR. Next, the assessee is also getting some rental income. On rental income, REIT does not pay tax. It is exempt in the hands of REIT, but it is taxable in the hands of the investor. Now the question is, under which head it is taxable in the hands of investor? It is taxable under PGBP, remember, because the REIT's activity is to buy and sell property. The REIT's activity is real estate. Therefore, for REIT, the rental income is a PGBP income. And whatever is the nature of income in the hands of REIT, that same is the nature of income in the hands of the investor as per the income tax law. Therefore, this 4 lakh rupees will be chargeable as PGBP income of the investor and not HP income. Be very careful. Okay. Next, depreciation you can reduce. And last but not least, 80 JJAA you can claim For first employee, 15 employees which were employed on 1st April, regular employees participate in the recognized provident fund. Remember, it is important that if you want 80JJAA, your employees should participate in the recognized provident fund. Otherwise, you will not get 80JJAA deduction. And plus, the emolument has to be up to 25,000 rupees, and plus, they should be employed for at least 240 days in a financial year. Therefore, the first category of employees will be eligible for that because they are employed on 1st April. 240 days criteria will be full. Regular employees, they are participating in what? In the recognized provident fund, and 24,000 is less than 25,000. Therefore, they are eligible. Therefore, how will you compute? 15 into 24,000 into 12 months into 30%. The second category of employees not eligible because their emolument is more than 25,000. The third category also not eligible because the employees are casual. They are not participating in recognized provident fund. And the fourth category also not eligible because they are employed on 1st September. Therefore, they will not be able to fulfill 240 days criteria. This is how you are going to compute. Now, what is the tax rate under 115BAA? It is 22% tax plus 10% surcharge and 4% cess, and on long-term capital gains it will be 20% tax. Okay, it will be 20% tax directly. Okay, I hope it is clear to all of you. This is how you are going to compute the total income and tax liability of this particular assessee. Next question is a very simple question, nothing great as such. There is a company HE Private Limited which is a closely held company. Now remember, when any shareholder holds 10% or more in the closely held company and that company gives you a loan that amounts to deemed dividend. Do you remember that or not? So therefore, HE Private Limited is a closely held company and Priyanshu is an MD who holds 72% of the equity in that company, and now that company is giving a loan of how much? A loan of 5.5 crore rupees to Mr. Priyanshu. Okay, to Mr. Priyanshu. Now that will be deemed dividend in the hands of Mr. Priyanshu, but the deemed dividend as per section 222E cannot be more than the accumulated reserve. Now what is the reserve with the company? The reserve is 8 lakhs and the loan is 5.5 lakhs. Therefore, deemed dividend will be only 5.5 lakhs. Now they have made you some emotional effect over here. That is, he has in turn given this loan to somebody else. It doesn't matter all those things. Okay, it doesn't matter. Once you have taken the loan, then you have repaid, you have given it to someone. All those things are bullshit. It is of no use. It is taxable in your hand as deemed dividend. Okay, I hope it is clear to all of you. Now the next question is a very simple question on DTAA. We have done much better questions on DTAA, so therefore DTAA questions I am not going to speak much unless and until something unique comes. It's a very simple question. You can go through it. Very simple question. I am not interested in that question much here, please. Now question number 3. Now remember, in mock test paper, because we have already done with 15 papers, 8 RTPs and 7 exam papers, 15 papers are already done. So in mock test paper, there are a lot of questions which are going to be repeated now. So any question which is exactly repeating, not partially repeating. If it is exactly repeating, I am not going to do that question. If it is partially repeating, I will definitely do that. Therefore, this question is exactly repeating, like I have made a reference also. Same as earlier RTP question number 12. This question also exactly repeating as same as question number 14 of RTP discussion. You can go and check. That's the reason I have given the reference also. So if something is exactly repeating, I am not going to repeat that. If something is partially repeating, still I will repeat that. Don't worry. Okay. Now the next question. Question number 4, part A is about TDS. Now there is a bank. Remember, when does the bank deduct TDS under section 194A? The bank will deduct TDS under section 194A on the date of credit or date of payment, whichever is earlier. Now the bank has a policy of computing interest on a daily basis. The bank computes interest on a daily basis, and after computing, they credit that amount to a separate account for macro monitoring purpose. So whomsoever is the customer, there are lakhs of customers, they will compute interest on a daily basis and they will credit to a separate account, and they will pay to the customers on a quarterly basis, half yearly basis, yearly basis. So the question is, when the bank is computing interest on a daily basis for macro monitoring purpose and they are crediting that interest cumulatively to a separate account, are they liable to deduct TDS? The court has said that no, they are not liable to deduct TDS, and therefore the interest of the bank should not be disallowed. The AO has disallowed the interest to the extent of 30% by saying that the bank has not deducted the TDS on time. Therefore, this is wrong. The next question is on equalization levy. There is a foreign company, Messrs. ITEX, which is incorporated in Japan. If that company does not have a PE, now that company is providing us an online advertisement service. Okay, they are providing us an online advertisement service, but the payment of that online advertisement service does not exceed 1 lakh rupees. Remember, a non-resident who does not have a PE providing online advertisement services to a resident, and we are paying less than 1 lakh rupees, not more than 1 lakh rupees, then 2016 equalization levy cannot be made applicable. 2016 equalization levy is applicable only if the payment made is more than 1 lakh rupees. Therefore, here 2020 equalization levy will be applicable, and as per 2020 equalization levy, one more criteria has to be checked, that whether the services which are provided of online advertisement has to be at least 2 crore or more. Yes, the services is of 2 crore, 2.1 crore. Therefore, 2020 equalization levy will apply 2% at 2.1 crore. This is how we are going to approach this. If this would have been more than 1 lakh rupees, then we would have applied 2016 equalization levy. I hope it is clear to all of you. Okay. Now, The next question is again a theory question. There was a search conducted under section 132 in the premise of Mr. X on 30th of April 2023, and the officer found some undisclosed money, undisclosed jewelry. Now, we are asked that whether any penalty will be imposed on the assessee. The answer is yes. There is a specific penalty for search and seizure, if you remember, under section 271 AAB. But to understand 271 AAB, you need to understand two terms first of all. That is specified previous year and specified date. So what is specified previous year? In specified previous year, there are 2 points. First is a year prior to the year of search. A year prior to the year of search for which the due date of filing of return has not come and you have also not filed the return. That previous year, that preceding year will be called as what? Specified previous year. Second point in specified previous year is the year of search. That is 23-24. So one is 22-23, second is 23-24. Now what is specified date? For last year, the specified date is date as per section notice of section 148. Whatever is the time limit given to file the return under section 148, that will be the specified date for last year. And for current year, the specified date will be the due date as per section 139, subsection 1 of the Income Tax Act. You have to determine these two dates first of all. That is specified previous year and specified date. After that, what am I supposed to do? After that, you are supposed to compute what? After that, you are supposed to read the provisions of 271 AAB. Now, the law says that if any undisclosed money, bullion, jewelry, etc. is found, and if you are able to explain the nature and source by giving a statement under section 132 subsection 4 before the end of the search, during the course of the search, till the time the search is completed, if you are able to explain the nature and the source, and if you pay the tax on or before the specified date, you file the return on or before the specified date, you pay interest on or before the specified date, then in that case, we will impose 30% of the undisclosed income as penalty. 30% of undisclosed income of the penalty will still be imposed even if you explain during the course of search. But if you are not able to explain during the course of search, or if you are not able to pay the tax or interest on time or file the ITR on time, then we will impose 60% of the undisclosed income as what? As your penalty. This is what this theory question is all about. You can go through it. The next question, question number 6, the first one is a theory question. You can read it through at your end. The second question is a question on GAR. It's a beautiful question. Listen carefully. IPSE is an Indian company, okay, and there is another company, then company which is in X country X, okay. IPSE in India and then is in country X. Now, deliberately, then opens one subsidiary in country Y, which is known as Zen, and then holds 100% shares of that particular company, okay. Now, IPSE enters into a joint venture with REN Limited, and in this REN Limited, 51% of the shares is of IPSE and 49% of the shares is of Zen Limited. Now, why they have done so? What is the objective behind it? What is the rationale behind it? Let me tell you the rationale behind it. India and country X DTAA says that there is a capital gain tax which will be charged. Okay. So, if there is any transaction between India and country X, capital gains will be charged. But India and country Y DTAA says that there is no capital gain tax. Okay. So, what then has done? Rather than directly holding the shares in REN, then has made one subsidiary in a country in which there is no tax, and then through that subsidiary he has purchased the shares of REN Limited, and now Zen is transferring the shares of REN Limited and saying that India and country by DTAA says that capital gain should not be chargeable. There is no other activity done by Zen except to buy these shares and then later on to sell these shares. Therefore, it's a clear case of what? It's a clear case of GAR. Why? Because there is no commercial substance in making this particular entity. Why the hell you have made this entity Zen? Only to obtain tax benefit. Why the hell you have made this company Zen? This does not have any commercial substance. This lacks commercial substance. Therefore, GAR will be imposed in this case if the tax benefit is more than what? More than 3 crore rupees. Otherwise, GAR is not applicable. GAR is only applicable if the tax benefit is more than 3 crore rupees to the SSE. So, this is what this question is all about. One last question over here is Flex Limited. It's a foreign company. It has earned the following incomes. The very first thing it has earned is it has earned dividend of 8,50,000 from GDR. Now, this is taxable at the rate of 10% under section 115 BAC. Similarly, they have also earned some dividend on the equity shares of Indian company. This is taxable at 20% under section 115A. Okay. Now, the third one is a very, very critical point. They have received now some royalty. It is not earned. In the first 2 points, it was earned. So, it was an income. In the third point, it is received. So, here you have to gross it up because it is received and you receive after deduction of TDS. Okay. So, 8,76,000 you have received as a royalty. Okay. In respect of which, in pursuance of an agreement between Flip and Flag. But the agreement is not approved by central government. Therefore, you cannot apply 115A. For 115A to apply, the agreement has to be approved between two parties. Here, the agreement is not approved. Therefore, 115A cannot be applied. Therefore, how much, at what rate this will be taxable? This will be taxable at normal rate, not at 115A rate. That is 8,76,000 will be taxable at 40% plus 4% says 41.6%. But you have to gross it up. Okay. You have to gross it up. How you will gross it up? You will say that 8,76,000 is 59.4%. Therefore, 100 is how much? cross multiply and gross it up because it is written the word received. Okay, you have to be very careful. Business income will be taxable at 40%. Okay, and the last adjustment, we have done similar adjustment earlier also, that is that now there is an agreement between both the party which is approved by central government, and you are providing some technical services, therefore it will be taxable under 115A. Okay, now but the foreign company is providing you technical services, and in return you are giving what? You are not giving money, you are giving debentures. So this 32 lakhs will be taxable at 115A, 20%. Why? Because there is an agreement which is approved by central government. But on this debenture, they are also earning some interest of 2,88,000. It will be taxable at 40%. Why not at 115A, 20%, sir? Because in 115A, 20%, the loan has to be given in foreign currency. And here the loan is not given in foreign currency, it is in Indian currency. Therefore, it will be taxable at 40% only. Therefore, interest will be taxable at 40% and FTS will be taxable at 20% as per 115A. Okay. And interest will be taxable as per general rate. So this is what this MTP is all about. So now let's move on to the next MTP, that is MTP Series 2, November 2022. That is the first question again on PGBP. The SSC is a manufacturer. You are not going to follow over here MAT or 115BAA. You are just supposed to compute the business income of the SSC, no tax liability also. Okay. Now the very first adjustment over here, the net profit is 560 lakhs, the depreciation as per books of accounts 52 lakhs which will be added back. Then you are receiving some concession, power tariff concession from Uttar Pradesh government, that is an income under section 224(18). Any concession, any relief from government will be taxable under PGBP. Therefore, let it be part of PGBP. It is already credited to the PNL. You don't have to do anything. Okay. Then you are making some contribution to National Laboratory of 2.5 lakhs. It is allowed as deduction under section 35(2AA). It is already debited. Therefore, ignore it. Okay. Next, you are selling some plot of land. You are transferring some plot of land to a domestic company, 100% holding subsidiary, and the recipient is an Indian company. Unlike the previous question where the recipient was a foreign company, here it is Indian company, therefore it is exempt. Therefore reduce from here, write a note that it is exempt under section 47. There is no need to pay tax on that. Okay. The next one is a very good adjustment. You are making some payment of 3.5 lakhs to a transporter who is a partnership firm, but on that particular amount you have not deducted TDS under 194C. The transporter is giving a declaration that he is following 44AE. He is giving a declaration and there is a permanent account number, no TDS. Do you remember that? If the transporter is following 44AE, that is if the transporter does not have more than 10 trucks during any time during the previous year, and he gives a declaration to you and he also gives a PAN with the declaration, then 194C is not applicable in that case. Therefore, in this case 194C is not applicable. Okay. Now, you have paid some interest of 15 lakhs on loan taken specifically for purchase of second-hand plant and machinery. Out of that, 5 lakh is for the period till the machinery was installed. Okay. So till the time the machinery is not installed, that interest will be capitalized to the cost of the machinery. Okay. So therefore 5 lakhs will be disallowed here, and on that 5 lakhs you will claim normal depreciation. Additional depreciation will not be claimed because it is the second-hand plant and machinery. Okay. Total 15 lakh interest is there. 10 lakh will be allowed to you because it is paid, and it is post period of usage. After you have used, after the usage of the machinery you have put to use, and then you have paid an interest of 10 lakh rupees. But before you have put to use, you have paid an interest of 5 lakh rupees. Add to the PGBP income, it is not allowed as a PGBP expense, and on that 5 lakh rupees you will be getting what? Normal depreciation. Additional depreciation not allowed. Okay. Then there is some bad debts. There is a bad debts which is written off by you. It will be allowed as deduction under section 3617. Then you have got some additional compensation from state government in respect of a compulsory acquisition through an interim order. Remember, if you receive anything to an interim order, then that is not taxable now. That is taxable in the year in which the final order is passed. Therefore, reduce from here and write a note that interim order money will be taxable in the year in which the final order will be passed by the court. Okay. Right now it is not taxable. Then there is some concept of equalization levy. There is a foreign company who does not have a PE in India, and that foreign company is giving us services of online advertisement services, and we are also making the payment of more than 1 lakh, that is 5 lakh rupees. Then we should have deducted equalization levy. We have failed to deduct equalization levy. Therefore, this expenditure will be disallowed under the income tax law. Then we have incurred some 2 lakh rupees on foreign travel of 2 directors for some collaboration of new construction project, but the collaboration did not work out. The collaboration did not work, and therefore the project was abandoned. Therefore, whatever expenditure you have incurred for this particular foreign travel, it will be disallowed as it is a capital expenditure. Okay. Next one, normal depreciation of 71 lakhs you can claim as a deduction. Next one, you have issued some debentures at a discount of 3%. Total value of debentures is 1500 lakhs. So on that 3%, whatever is that will be allowed as deduction over the life of the debenture. So whatever that 3% comes to, it will be allowed over the period of 5 years. You have to divide that by 5, and then that will be apportioned over 5 years. Next one, you have received some bill of 3 lakh rupees for the month of March, but you failed to record that in the month of March. You recorded in the month of April. That is wrong. You should record in the month of March. You have purchased that particular inventory in March, so you should record that in the March, and therefore take deduction in the month of March only. Take deduction in the current year itself. Okay. And one last thing, you have purchased some cotton bales from your related party, that is directors, at a price higher than the normal price. The normal price is 4,600. You have purchased at 5,000. Therefore, 400 rupees will be added as an excess payment to related party. 48 into 1,000 bills. Okay. This is how you are going to compute this question. Very simple question. Nothing great as such. Okay. Let's move on to the next question. The next question is on book profit and your minimum alternate tax. How to compute book profit? Let's see. Your book profit will be computed as follows. Net profit as per P&L. And then there are some items which are credited, some items which are debited. Let's see which all items have to be adjusted and which all items have to be ignored. The first item is profit from ATIA. ATIA profits are not adjusted. Let it be part of book profit. Dividend from investment in Indian companies. Dividend from Indian companies are also not adjusted. Let it be part of book profit. Agriculture income will be reduced because on section 10 income, MAT is not applicable. Then depreciation you will add back and then you will reduce depreciation other than revaluation. Okay. So 10 lakhs you will add back and other than revaluation you will reduce. How much is the other than revaluation? 1,90,000 is revaluation on asset depreciation. Okay. Depreciation on 1,90,000 is on revaluation of asset. Therefore, other than revaluation will be out of 10 lakh, reduce 1,90,000, 8,10,000 will be other than revaluation. Okay. Penalty is not disallowed under the MAT provisions. Provision for GST is not disallowed under the MAT provision. Provision for doubtful debts, yes, it is disallowed under the MAT provision. Then interest, even if it is paid or unpaid, it doesn't matter. It is not disallowed under the MAT provision. And last but not least, provision for what transfer to reserves. If you transfer to any reserves, then it is disallowed under the MAT provisions. Okay. Then they have given some extra information to us, that is depreciation of as per income tax rules, not relevant in MAT, that is relevant under the normal provision. Then they have said that the company has not debited some interest on borrowed capital in the P&L account. Forget about it. Whatever P&L is given to you, you have to accept that. You cannot make changes in the P&L as per the Supreme Court judgment of Apollo Tyres Limited. Remember or not? You have no right, being an assessing officer, you have no right to change the P&L account. Okay. Therefore, don't make any changes in the P&L account. GST remitted before the, I am not interested. Whether GST is remitted or not remitted, under MAT provision, it is of no use. Under the normal income tax provision, if GST is not remitted on or before the due date of filing of return, it is disallowed as per section 43B. But in MAT, it is of no use. Okay. Now let's move on to the next question. We need to answer whether transfer pricing will apply in these cases or not. Okay. Very good question. There is a company ABC INC which holds 32% shares of Alpha Limited. Whether transfer pricing will apply between these two? The answer is yes. Then there is an Alpha Limited which holds 75% in Beta Limited. Whether transfer pricing will apply? Yes, 26% or more. That is not the question. Whether transfer pricing will apply between ABC INC in Beta or not? That is the question. So for that purpose, we need to see ABC holds how much in Alpha? ABC holds 32% in Alpha. And in return, Alpha holds 75% in Beta. Therefore, indirectly, ABC holds how much percent in Beta? ABC holds 75% ka 32%. ABC holds 75% ka 32% in Beta, which comes to 24%. Check. 75% of 32%, which comes to 24%, which is less than 26%. Therefore, it will not be subject to what? Transfer pricing provision. I hope it is clear to all of you. Next one is a question on domestic transfer pricing. Always remember, whenever there is a question on development of highway project, etc., always remember ATIA is applicable. So one entity is eligible for ATIA, another entity is not eligible for ATIA. Is domestic transfer pricing applicable between both of them? Yes, it is applicable, because one entity is eligible unit, another entity is non-eligible unit. Domestic transfer pricing may apply, but here in this case it is not applied, because if we consider the value of transaction, it is less than 20 crore. Remember, for domestic transfer pricing to apply, the value of domestic transaction should exceed 20 crore rupees. Otherwise, domestic transfer pricing is not applicable in the SSC's case. Next one is a very intelligent question. A Limited is a power generation SSC opting for 115 BAB. Remember, if one unit is opting for 115 BAB and another unit is not opting for 115 BAB, and if they enter into a transaction, then also domestic transfer pricing is applicable. Again, the value of transaction should exceed 20 crore. In this case, if you do the multiplication 10,000 metric ton into 23,000 per metric ton, it exceeds 20 crore rupees. Therefore, here transfer pricing is applicable. In second case, it is not applicable because it is less than 20 crore rupees. I hope it is clear to all of you. It's a beautiful question. Okay. Now, the next question is a simple question on DTAA. Mrs. Radha, 39 years, citizen of India, resident of India. Very simple question. One important point to be kept in mind over here is she has paid some 35,000 rupees to ensure the health of her mother who is non-resident. Now, because the mother is non-resident and 63 years, you will only get 25,000 rupees deduction. You will not get 50,000 deduction. If the mother would have been resident, you would have got 50,000 deduction. This is the only thing that you have to keep it in mind. Okay. Apart from that, you need to follow the old regime in this question. You need to be very careful in May 2024 and November 2024 with old regime and new regime, because new regime has become the by default regime and old regime has become an optional regime. You have to be very careful with that particular aspect in the examination. Okay. Now the next question is on TDS. Again, a beautiful question. One, Mr. Aryan Mr. TDS and TCS both. Okay. Mr. Aryan, an Indian citizen, he came to India on a visit on 25th of Feb 2024. Therefore, he's definitely a non-resident. Okay. So because if somebody comes on 25th of Feb 2024, he hardly stayed in India for 1 month, 1.5 months. Okay. So therefore, he is a non-resident. Now, he came to India and he booked a tour for Malaysia of 5.2 lakh rupees. Remember, for if you book a tour for outside India, overseas tour package program, you are liable for what? TCS. But in this case, the CBDT has given a notification that if a non-resident comes to India for a visit and if he books a tour operation, etc., or sends money outside India, then the provisions of 2061G is not applicable. This is a non-resident who is coming to India for a visit, then provisions of 2061G is not applicable, not applicable, not applicable. Next question. Srishti was incorporated in the current year. That is 23-24, Srishti was incorporated. This is the first year of Srishti Limited. And the turnover of Srishti in the current year is 14.5 lakh. It is purchasing some goods from Mrs. Philip Company. And the Philip Company is an old company. The Philip Company's last year turnover was 11 crore. Philip Company's current year turnover is 9.7 crore. So I am Srishti, I am buyer. You are Philip, you are seller. I am first year. This is my first year. Therefore, for me, 194Q will not apply. For 194Q to apply, the buyer should have a business turnover of more than 10 crore rupees in the last year. And in this case, the buyer does not have any business in the last year. Therefore, if 194Q is not applied, then whether seller will be liable for 2061H? Yes, seller will be liable for 2061H. On what basis? On the turnover of last year is more than 10 crore rupees. The seller's last year turnover is 11 crore. And seller is selling goods of more than what? More than 50 lakh rupees. Now seller will collect TCS, but in 2061H, remember, TCS is collected on receipt basis, not on receipt or debit, whichever is earlier. So whenever the amount is received, at that time it will be collected. And in the question it is written that the receipt is done after 1 month. Whenever the goods are sold, after 1 month of that, the payment is received. Therefore, on first 32 lakhs, no TCS, because TCS is applicable only on more than 50 lakhs. Next 31 lakhs, yes, TCS will be applicable on excess amount of 50 lakhs. 32 plus 31 comes to 61 lakhs, 63 lakhs, sorry. So what is more than 50 lakhs? 13 lakhs is more than 50 lakhs. 0.1% TCS will be applicable. But after 1 month, 18 September you have sold. So 18 October it will be, TCS will be collected on the date of receipt. Okay. Similarly, on this 18 lakhs also, it will be applicable on 18 December, not on 18 November. 18 November it is sold. And payment is received on 18th of December. So TCS under 2061H is applicable on receipt basis, not on receipt or debit, whichever is earlier. Okay. Be very, very careful about it. Next one is on 194O. It's a company like Amazon. Amazon is there and Amazon is selling some goods of 52 lakh rupees to a seller through a seller, that is e-commerce participant. But the seller unfortunately is not giving PAN and Aadhaar. So in 194O, generally we deduct TDS at 1%. But if the seller does not give PAN and Aadhaar, then what to do? Then we have to deduct TDS at the rate of 5%, not 20%. Remember, there are two sections under TDS where if the payee does not give the PAN or Aadhaar, then you have to deduct TDS only at 5%. One is 194O, another is 194Q. These are the two sections where the TDS will be not deducted at 20%, but only at 5%. Okay. The next question is again on equalization levy, but a beautiful question. There is one company, Turnip Inc., and another company, Sam Inc. Now, Sam is providing online advertisement to Turnip. Now, we need to make three assumptions over here. How much receipt is there of Sam? Sam is having a receipt of 4.2 crore rupees. And how much Turnip is paying? Turnip is paying 5 crore rupees, 5 lakh rupees to Sam. Okay. So, one entity is providing online advertisement service to another entity. The total turnover is 4.2 crore rupees. And they are providing, and the person who is receiving the services is making a payment of 5 lakh rupees. Now we need to make three assumptions. Assumption one, both Turnip and Sam has no permanent establishment. So Sam does not have permanent establishment, even Turnip does not have permanent establishment. Remember, now we will need to always start with 2016 equalization levy. Whether 2016 equalization levy will apply, the answer is no. Why? Because in 2016 equalization levy, Turnip has to be either resident or Turnip should be a non-resident who has a P in India. Now Turnip is neither resident nor a non-resident who has a P in India. Therefore, 2016 equalization levy is not applicable. Whether 2020 equalization levy will be applicable? The answer is yes. Because in that case, Sam is an e-commerce operator providing online advertisement services to another non-resident who is targeting Indian customers. See, to increase its shares in market in India. Okay. So, because it is targeting Indian customer, 2020 equalization levy will apply. 2% equalization levy will apply because the limit is also more than or equal to 2 crore rupees. The turnover in India is more than equal to 2 crore. Therefore, 2% equalization levy will apply in this case. Second case, if Turnip has a permanent establishment, then it is a classic case of 2016 equalization levy. Why? Because Sam is a non-resident who does not have a P providing online advertisement service. Turnip is a non-resident who has a PE and making a payment for online advertisement of more than 1 lakh rupees. Therefore, Turnip will be liable for what? Deducting the equalization levy as per section 165 2016 equalization levy 6%. If it does not deduct, the expenditure will be disallowed. Once it deducts and makes the payment, then Sam will not be liable to tax. Third case, both of them has a permanent establishment. If both has permanent establishment, Sam has permanent establishment in India, then the question of equalization levy will never arise. In that case, Sam will be liable for income tax because his income is deemed to accrue or rise in India as per section 911. If Sam's income is deemed to, Sam has a P in India, it is attracted under 911, his income is deemed to accrue rise in India, therefore the question of equalization levy will not arise in this case, okay? I hope it is clear to all of you. So it's a beautiful, beautiful question. Next question, Mr. Sanjay, he has filed a return of income and in the return he has declared an income of 52 lakh rupees, okay? After that, the AO has done an assessment and AO has increased the income by 3,20,000 rupees. Now the assessee wants to go for what? The assessee wants to go for what? Dispute resolution committee. Can assessee approach dispute resolution committee? The answer is no. Why, sir? The assessee is violating the condition. Which condition assessee is violating? One of the condition to go to dispute resolution committee is your returned income should not be more than 50 lakh rupees. Your the return income is 52 lakh rupees. Therefore, it is not possible to go to what? Dispute resolution committee. Therefore, what is the other remedy available with the assessee? Assessee can go to CIT appeal within 30 days or joint commission appeal within 30 days from the date of receipt of notice of demand, or assessee can go for revision under 264. But the dispute resolution committee doors are closed for the assessee. Okay. Now, one last question over here, question number 6 in this particular MTP. First question, there is an Indian company who is engaged in some business and the turnover of last year is more than 50 crore rupees. Remember, any assessee who is doing a business, whose last year turnover is more than 50 crore rupees, they have to keep certain mode of payments in the business like debit card, RuPay, QR code, UPI as per section 269 SU. But this assessee is saying we only have cash, check, credit card and debit card. We don't have all these things. So is it allowed? It's a violation of 269 SU and therefore there will be a penalty of 271 DB imposed on you, which is 5,000 rupees per day till the time you install these mode of payment in your business. Okay. I hope it is clear to all of you. Next one is a question on whether GAR will apply or not. There is an assessee who has two manufacturing units. One is in SEZ and another is in non-SEZ. Now, the unit which is there in SEZ, that is not doing manufacturing. Manufacturing is done by non-SEZ unit and the SEZ unit is doing only packing. Only packing is done by SEZ unit and non-SEZ unit is doing what? Manufacturing. Therefore, this is a clear case of tax evasion. Then because it is a case of tax evasion, therefore GAR will not apply in this case. Okay. Second one is a very simple case. One unit is is in SEZ and another is in non-SEZ. So one is eligible for 10AA, another is not eligible for 10AA. If they enter into a transaction between both of them, then domestic transfer pricing will apply. Therefore, GAR will not apply because there is a specific SAR, specific anti-avoidance rule. Therefore, the GAR provisions will not be applicable in this case. Okay. And one last question over here is a beautiful question. XYZ Limited is a company in country P. They have entered into an agreement with G Limited and Y Limited, an Indian company. Okay. And for providing technical services to them and which is approved by central government and therefore there is an agreement. Therefore, the provisions of 115A will apply. Whenever there is an approved by central government written words is there in the examination, it means 115A or 44DA will apply. Now, we need to solve this question in two ways. Assuming that the company does not have a P in India. If company does not have a P in India, then the provisions of 115A will apply. And if 115A will apply, how will we compute the income? First of all, this is 250 lakhs. The expenses will not be allowed in 115A. Another receipt is 302 lakhs. Again, expenses will not be allowed in 115A. Okay. All these expenses will not be allowed. So 265 plus 302, this is the receipt. On that 20% income tax will be charged. 2% surcharge will be charged because the income is more than 1 crore up to 10 crore. Therefore, 2% surcharge on foreign company and 4% cess will be charged. Okay. Now, if we assume that whether the assessee will be liable for filing return under 115A, no. If the assessee has only earned this income and the TDS is deducted as per section 115A, not lower than the rate specified in 115A, then there is no need to file the income tax return also. Okay. Now, if we follow 44DA, then what will happen? Then assessee will get all the expenses deduction except some expenses which I am going to tell you now. Against 265, 35 lakhs will be allowed as deduction. Against 302, because this is directly related to that particular income. But an expense which is not wholly incurred for the Indian branch will not be allowed as deduction. Further, an expense which is not in the nature of reimbursement to HO, it will also not be allowed. Only reimbursement to HO will be allowed as deduction, not other expenses which is not in the nature of reimbursement. Yes, if you have taken some services from third party and your HO has paid that payment to third party, and if you are reimbursing them, then that will be allowed as a deduction under 44DA. In 44DA, you are supposed to maintain the books of account, you are supposed to conduct the tax audit, you are supposed to file the ROI also, return of income, and you are liable for tax rate at 40%, which is applicable to normal companies. Okay, so this is what this MTP is all about. So let's move on to the next MTP, that is MTP Series 1, May 2023. There is an assessee by the name called as Risk Hospitality Limited, 3-star category hotel is there. But unfortunately, we need to be very careful with the last line. Otherwise, you will read the entire question and don't read the last line. That the assessee is not eligible for 3580. Even though it is a 3-star hotel, don't claim 3580 deduction. Okay. Let's start with the adjustment. 152 lakh is the profit. 25,000 is paid to Mr. Raja, an agriculturist, for purchasing a corn in cash. Okay. So can you make the payment in cash? Can you make the payment in cash to purchase an agricultural product? Yes, you can. Therefore, this 25,000 will be allowed as deduction. Next 30,000 is made as payment to Mr. Khalid to purchase masala. Now, masala is not an agriculture product. Corn is an agriculture product. Masala is not an agriculture product. So only if you purchase an agriculture product from a farmer, then rule 6DD is applicable and you can make the payment of more than 10,000 rupees in cash. So for corn, it will be allowed. For masala, it will not be allowed. Okay. Next one is a pension. Employer is contributing some amount to pension of the employee. Now, how much deduction is allowed to the employer? Only up to 10% of basic salary and DA in terms. Up to 10% of basic and DA in terms. Now, how much the company is paying? Company is paying 3 lakh rupees and it is 12% of basic and DA in terms. Okay. So, how much will be disallowed? 2% has to be disallowed. Therefore, 2% will come to 50,000. 50,000 should be disallowed under the income tax law. Okay. Only up to 10% of basic and DA in terms is allowed as deduction. Now, the next adjustment is a similar adjustment which you have done in the previous paper also, that you have made a payment of 6.5 lakhs to a transporter without deduction of TDS, but the transporter is following 44AE. Therefore, transporter does not have more than 10 trucks. The transporter is giving declaration also. The transporter is giving PAN also. Therefore, no TDS under 194C. Okay. The next one is also a very simple adjustment. You are selling some land to a 100% subsidiary, which is a domestic company, which is an Indian company. So if you transfer a capital asset to your 100% subsidiary, and if the subsidiary company is what is an Indian company, then in that case, provisions of capital gains are not applicable. It is exempt. So reduce from here and write a note that it is exempt under section 47. Okay. Next one, you are making some payment of 2.5 lakh rupees to IIT, which is allowed as deduction under section 35 2AA. Next one, again a similar adjustment. 2 directors have went for foreign travel. The project was abandoned. Therefore, it is a capital expenditure. Therefore, it will not be allowed as deduction. Okay. Next, you have paid some 1 lakh rupees to directors, independent directors, for attending board meeting. So whenever you make payment to directors over and above salary, then the TDS is deductible under 194J at the rate of 10%. Therefore, here you have not deducted the TDS. Therefore, 30% of the expenditure will be disallowed under the income tax law. Depreciation will be disallowed. Again, next one is a similar adjustment. You have received some amount as an additional compensation in pursuance of an interim order of an court. So whenever you receive any amount in pursuance of an interim order, it will be taxable in the year in which the final order is passed. So right now, reduce from here, it is not taxable as of now. Then you have received some dividend from foreign company of 5 lakh rupees. So reduce from here and show under IFOS, and you have distributed dividend of 7 lakh rupees to the shareholder on or before 1 month prior to the due date of filing of return. So you will get deduction under ATM. But you have received 5 lakh rupees and you have distributed 7 lakh. So you will get deduction of lower of the two, only 5 lakh rupees. Okay. I hope it is clear. Next adjustment, depreciation of 15 lakhs, which is as per income tax rules. You have to reduce that. Next adjustment, again, it is repeating. See, you have purchased some goods in the month of March, but the bill was omitted to be recorded. So you recorded that in the month of April. You should not do that. You should record in the month of March only. So therefore, because the expenditure pertains to March, therefore you should record in March only, and you can take the deduction in March itself. Okay. This is how you are going to compute the total income of Pratik Hospitality Limited. A very simple question. The next question is exactly similar. We have done this question earlier. You can check it in your RTP or MTP. Somewhere we have done it. And MTP not, RTP or past paper we have definitely done it. Same question with same numbers. That's the reason I'm not repeating unnecessarily this question. You can check it once if you want. Okay. The next question is a simple question on DTAA, and simple question on DTAA doesn't make sense to repeat again and again. In DTAA, what you are supposed to do? First, you are supposed to compute income, take all the incomes, compute tax, find out the average rate. After that, find out how much is the doubly tax income and apply the foreign rate or Indian average rate, whichever is lower, on doubly tax income, and take the relief under section 91. So it's a very simple question, nothing great as such. Okay. Now let's move on to the next question. Question number 3, part 1. There is an assessee who has gone to advanced ruling, and assessee is aggrieved by the advanced ruling. Now, is there any remedy available to the assessee? Yes. Assessee can go to High Court within 60 days. Assessee can go and appeal to High Court within 60 days. If there is a genuine cause, then assessee will also get a discussion. Assessee will also get a extension of 30 days more. This also we have done earlier, but still it is an important point. That's the reason I'm saying it once again. Okay. Next question is on equalization levy. Okay. There is a foreign company, XYZ INC. XYZ and company are non-resident. Now that company does not have a P in India. Now that company is having an e-website. That is, it is like an Amazon. It has a website. Okay. Now through that they are selling some goods manufactured by it. So therefore 2016 equalization levy is not possible. Why, sir? 2016 equalization levy is only applicable in case of online advertisement services. It is not applicable for sale of goods, or it is not applicable for provision of other services other than online advertisement service. Therefore, 2016 equalization levy is not possible here. Only 2020 equalization levy is possible. For 2020 equalization levy, what is the condition? There has to be an e-commerce operator who should be non-resident. He should not have any PE in India, and the services and the goods sold in India should be at least of 2 crore rupees or more. Okay. Therefore, let's see how much. Is he a non-resident? Yes, he is a non-resident. Does it have an e-commerce website? Yes, it has an e-commerce website. Does it have a PE? No, it doesn't have a PE. Now we need to check only one thing, whether the services and the goods sold to India is at least of 2 crore or not. Therefore, 158 lakhs is sold to person resident in India, it will come. And 96 lakhs is sold to person not resident in India. But out of this 96 lakhs, 57 lakhs is sold to persons who are using IP address located in India. Therefore, out of this 96 lakhs, 57 lakh will be considered in the turnover limit of 2 crore rupees. Okay. Therefore, 158 plus 57 comes to 215 lakhs. Of that, 2% equalization levy will be applicable in the hands of XYZ company. I hope it is clear to all of you. Now, question number 4 is on TDS. We need to say whether TDS will be applicable or not. Okay. Now, Mr. X has made 3 separate transactions. First, he has purchased a house property of 90 lakh rupees. Okay. But the stamp duty value of that house property is 95 lakhs. So, is TDS applicable? The answer is yes. 194 IA will be applicable at the rate of 1% on higher of the sale consideration or stamp duty value, whichever is higher. Therefore, on 95 lakhs, Mr. X is liable to deduct TDS under section 195, 194 IA. Second, he has purchased an urban plot of 49 lakh 50,000 rupees. And the stamp duty value of that plot is 48 lakhs. Therefore, the stamp duty value as well as the sale consideration, both of them is less than 50 lakhs. Therefore, no TDS on this particular transaction. And third one is a rural agricultural land. Rural agricultural land is exempt under section 194 IA. 194 IA does not talk about deduction of TDS on rural agricultural land. Therefore, do not deduct TDS on that. Next one. Thus, TDS on commission retained by consignee is applicable? Yes, TDS is applicable even if the commission is retained by the consignee. For example, I tell my consignee that you sell the goods on my behalf, and whatever goods you will sell, out of that 10% you retain your commission and balance you give it to me. Okay. Suppose you sell 1,50,000 rupees goods, 15,000 you retain and balance 1,35,000 you give to me. Then on that 15,000 which is retained by the consignee, on that also TDS is applicable under the income tax law. Be very careful. Next one is a salaried assessee. He is earning a salary of 55,000 rupees per month. Therefore, 55,000 into 12 will be his salary. Plus, he has also taken a house property which is on loan. On that, he has paid an interest of 80,000 rupees. So, 80,000 rupees SOP interest also he will get deduction. He is following old regime. So, on that, the assessee, the company will deduct TDS on slab rates. Okay. So, we need to compute properly the tax of the assessee. 655,000 into 12 minus 50,000 standard deduction. Then, whatever income will come, less 80,000 rupees house property loss. Whatever income will come, on that, they have to apply the tax rate. Okay. And then, accordingly, the company will deduct the TDS. One last thing over here in the question of TDS is Mr. Anand is an individual and the last year turnover of individual is more than 1 crore rupees. Last year turnover is 202 lakhs. Therefore, 194I will be applicable on rental income. Okay. 194I is applicable to individual HUF when the last year business turnover is more than 1 crore or last year profession turnover is more than 50 lakh rupees. Here, Mr. Anand is doing business. His last year business turnover is more than 1 crore. Therefore, 194I is applicable. And in 194I, the limit of TDS threshold is 2,40,000, which is aggregate of everything. Plant, machinery, equipment, furniture, land, building. Everything taking together should exceed how much? Should exceed 2,40,000 rupees. Now, the assessee has paid 15,000 rupees per month for office. Therefore, 15,000 into 12 will come to 1,80,000. On that, the assessee will deduct 110% TDS. And the assessee has also taken furniture and fixture of 6,000 rupees. That is 72,000. Therefore, 1,80,000 plus 72,000, we have to see aggregate. Under 194I, we have to see aggregate. Therefore, it crosses 2,40,000 and therefore 10% TDS on both of them. Sir, furniture is also subject to 10% TDS? Yes. Land, building and furniture is subject to 10% TDS. Plant, machinery and equipment is subject to 2% TDS. So you have to be very careful with this particular part. Okay. Now the next question is a beautiful question. It's a very, very good question. So mark this down. It's a different kind of question as compared to the other question. There is an FII. Remember, whenever there is an FII, there are two sections which should be clicked to your mind. One is 194LD, which is covered under 115A. 194LD, which is covered under 115A. And second is 115AD. 115AD, which is a separate section. Okay. Therefore, these two sections should come to your mind whenever FII provisions come in the examination. First of all, rupee denominated bond of FII of Indian company is covered in 194LD. Go and check. In 194LD, if an FII buys a rupee denominated bond of an Indian company, the interest will be taxable at 5%, 5%, 5%. Dividend for all the non-residents will be taxable under 115A at 20%. Okay. And interest on securities, okay, will be taxable at 20% under 115AD, 17,32,000. No deduction of expenses will be allowed under 115AD. This is what I am saying from the provision. You will say, from where are you saying all this data? You open the book and check, you will get all these things in your respective books, okay, from whichever books you are reading. Now the SSC has also sold some security. First, the SSC has sold some bond which was purchased in 2017, sold in 2023. Therefore, it will be covered in 115AD. But in 115AD, even though it is long term, purchased in 17, sold in 23, even though it is long term, but indexation benefit will not be available. Therefore, 47 lakhs minus 32 lakhs, 15 lakhs. And in 115AD, long-term capital gains, general long-term capital gains are taxable at 10%. Okay. Second is listed shares purchased in 2022 May, sold in February 2023. It is sold for less than 12 months and on which STT is paid. Therefore, this will be also covered in 115AD, and this is covered under 115AD, and therefore it will be taxable at 15% because it is the case of 111A because STT is paid on this. Okay. Third one is unlisted equity shares purchased in 2022, sold in 2023. Again, it is a short-term capital gains because the unlisted shares sold within 24 months are short-term capital gains. 8 lakh 40 minus 3 lakh 72 short-term capital gains. Normal short-term capital gains under 115AD is taxable at 30%. Remember, there are 4 capital gain rates given under 115AD. Normal long-term capital gain 10%. Normal short-term capital gains 30%. 111A short-term capital gains 15%. 112A long-term capital gains 10% subject to 1 lakh exemption. You have to be very careful with all these things. Okay. I hope it is clear to all of you. Now, coming to the next question. Question number 5. Question number 5 is a simple question. There is an SSC, Mrs. Srimati Kanti, who is engaged in growing, curing, roasting, grounding of coffee and has earned income of 6 lakh rupees. Therefore, how much will be taxable? Only 40% will be taxable and 60% will be exempt under the income tax law because there are specific rules which are applicable over here. Rule 7B. Therefore, 40% taxable is how much? 40% taxable comes to 2.4 lakhs. Now, because the taxable income is less than the basic exemption limit, which is just 2.4 lakh rupees, therefore the SSC is not liable to file the return. Because of this reason, SSC is not liable to file the return. But they have given one more reason. The SSC has traveled to USA. For that purpose, the SSC has incurred more than 2 lakh rupees for the purpose of foreign travel. So, if you incur more than 2 lakh rupees for the purpose of foreign travel, are you liable to file income tax return? Because of this reason now, 2.2 lakhs, the SSC is liable to file the income tax return. Next, some theory questions are there. The Commissioner of Income Tax Appeal has the power to enhance the assessment, plenary or quite wide. Yes, can the Commissioner of Income Tax enhance your assessment? See, the Commissioner of Income Tax has wide powers. The power of Commissioner of Income Tax is at co-terminus with the assessing officer. It means it is at par with the assessing officer. Okay. And the Commissioner of Income Tax can confirm the order of AO, can enhance the order of AO, can reduce the order of AO. All these powers are there with the Commissioner of Income Tax. Okay. Next one. At the time of hearing the rectification application, so when the rectification application is heard by the income tax tribunal, can they reappreciate the evidence produced before the appeal? The answer is no. I went to the ITAT for rectification under the income tax law for an apparent mistake, and the ITAT is altogether listening a new case. ITAT is altogether hearing altogether the new case. Can they do so? The answer is no. ITAT does not have the power to reappreciate the entire matter. ITAT can only rectify the apparent mistake which is there. It cannot rectify, it cannot reappreciate the entire matter. Okay. Next question. Question number 6 is a very simple question again. AY 22-23 order was passed by the assessing officer. Okay. But while making the order, the AO wrongly wrote as AY 21-22. Okay. So while making the assessment was of AY 22-23, but while making the order, the AO typological error. It was written as 21-22. So because of this reason, the SSC claimed that the entire assessment is what? Invalid. Can a typological error can make your assessment invalid? The answer is no. Section 292B is a section which protects such cases, which says that if there is any clerical mistake made by the income tax department, that cannot lead to what? Invalid assessment. The assessment will be invalid. The assessment will be valid, and it is absolutely correct in the eyes of the law. Okay. Now, next few questions we need to answer, whether it is tax planning, tax management, or tax evasion. The SSC is maintaining some register for TDS. It's a tax management. The SSC is obtaining some declaration from the lenders in form 15G, 15H, so that the department does not ask question to the SSC. It's a tax management. Third one, the SSC is purchasing some AC and putting in the residence of director, but showing that as what? As it is fit in the company, in the factory, and claiming depreciation. It's a clear case of tax evasion. Okay. Next, the SSC is paying 80,000 more brokerage to one of its director's son, so that the income of the director's son increases from 4 lakh 20 to 5 lakhs, and even on 4 lakh 20,000 there is no tax, even on 5 lakh there is no tax, but the company will get an advantage of deduction of 80,000 rupees. It's a tax evasion. And last one, the SSC makes a deposit of 1 lakh rupees in nationalized bank to save some tax. This is nothing but allowed under 80C. Therefore, it is a tax planning. Okay. And one last question over here is on transfer pricing, which is a very simple question. XC Limited is an Indian company and Zilla INC is a US company and it holds 28%. And therefore, if one entity holds 26% or more of voting power of another entity, then both of them are deemed to be associate enterprise. Now, XC Limited sold the t-shirts to Zilla at 2 per unit, whereas to unrelated party, it sells at 3 per unit. So to unrelated party, you are selling at higher price. To related party, you are selling at lower price. Therefore, differential amount has to be added back. $1 per unit into 1 lakh units into 64 is the dollar rate. Okay. Similarly, XC Limited borrowed $2 lakh from foreign lender based on guarantee of Zilla and it paid 10,000 as guarantee fee. Whereas to unrelated party, it pays a guarantee fee of $7,000. So to our associate enterprise, it pays a guarantee of $10,000. To other, it pays a guarantee of only $7,000. So we are paying $3,000 more to associate enterprise. So $3,000 into 64 will be added back. Okay. Similarly, you are paying some extra amount for getting various potential customers, some kind of commission. 15,000 to associate enterprise and to unrelated party, you are paying lesser 10,000. So the differential amount has to be added back 5,000 into 64. So therefore, this much is the amount of income which will be added back in the form of what? Primary adjustment. Now, the question over here is, please listen carefully. If these additions are made by AO, so if assessing officer makes this addition, can we claim deduction under 10AA on these additions? The answer is no. So whenever the arm's length price is increased by the assessing officer, so whatever arm's length price is increased by the assessing officer, on that much amount, you cannot claim deduction under 10AA, you cannot claim chapter 6 deduction. As per section 92C subsection 4 first proviso, okay? You cannot claim deduction on the amount which is increased by the assessing officer in the form of increase in arm's length price. No 10AA, no chapter 6A. I hope it is clear to all of you. This is what this MTP is all about. So let's move on to the next MTP, that is MTP Series 2 May 2023. The very first question is on PGBP income against XYZ Limited is a manufacturing assessee. And you're not supposed to follow MAD, you're not supposed to follow 115BAA, and the turnover of last year is 405 crore, which is more than 400 crore. Therefore, the tax rate will be 30% of the assessee. Okay, so these are the few things that I would like to start with the question. First thing is depreciation, you will disallow. The profit is 700 lakhs. Second thing is employer contribution, you can make the payment till the due date of filing of return, that is allowed. But employee contribution, you have to make the payment by 15th of the following month. Therefore, it is disallowed because it is paid after 15th of the following month. Okay, so employee contribution, you cannot make the payment after 15th of the following month. Next one is the repeated adjustment. You have received some industrial tariff concession from the state government, which is credited to the PNL. So any concession which is received from the state government is an income under section 224(18). Therefore, it will be chargeable under PGBP. The third adjustment is you are making some provision of 25 lakh rupees as a periodical wage revision, which is on a fair estimation. So after every 3 years, you see the performance of the employees, or you make some provision for wage revisions, and that is on a fair estimated basis. Therefore, it is allowed under the income tax law. Okay. Next one, you have made some provision for bad debts. So provision for bad debts are not allowed under the income tax law. That is disallowed. Provision for bad debts is only allowed to a bank and to NBFCs. Next one, you have charged some 40 lakh rupees as actual bad debts. Now actual bad debts is allowed as deduction under the income tax law under section 36(17). Provision for bad debts will not be allowed. Okay. Next one, you have purchased some goods of 50 lakh rupees. Now your creditors is giving you discount of 75%. It means 75% will be treated as your deemed income, but you have already credited that to PNL. Therefore, ignore this. You don't have to give any effect to that. Okay. Next is your opening stock and your closing stock is overvalued by 10%. So if your opening stock is overvalued by 10%, so divide that by 110%, find out how much it is overvalued, and you have to add back that. And if your closing stock is overvalued, it means your credit side of PNL is more. Therefore, reduce that much profit. 10% has to be reduced from your PNL. So in both the cases, you have to divide by 110%, and opening stock you have to add back, and closing stock you have to reduce. Provision for payment of gratuity is disallowed under income tax law. So 500 lakhs will be disallowed, but whatever provision is actually paid to the employees, that will be allowed under the income tax law. Next one, you are making some payment for recovery agent for realizing of debt, and you have deducted the TDS, you have also remitted the payment, everything is done properly. Therefore, your expenditure will be allowed under the income tax law. There is nothing wrong in that. Okay. Now, you are purchasing something from your related party, which is covered under 48(2). Directors are related party of the company, and you are making some excess payment. Therefore, excess payment will be disallowed under the income tax law. Okay. Next one, there is an addition to plant and machinery of 50 lakh rupees, which is used for more than 180 days, but unfortunately, you have not provided for additional depreciation, and you are a manufacturing assessee. You are not following 115BAA. Therefore, you are eligible for additional depreciation at the rate of 20%. Why 20%? Because it is put to use for more than 180 days. Okay. Normal depreciation 80 lakhs. You can claim that as deduction. No issues in that. Next one. Last year you have made a payment to contractor. Last year 2023. Last year you have made a payment to contractor, but the TDS of that is paid in the current year. Therefore, in the last year, the TDS was not paid. Therefore, 30% of 10 lakh would have been disallowed in the last year, and that 30% of 10 lakh will be allowed as deduction in the current year. So, in the current year profit, you can reduce 3 lakh rupees. Okay. And last but not least, you have collected 7 lakh as GST from the customer, and after that, you paid that to the government. So, 7 lakh you collected, 7 lakh you paid, so it is knocked off. Then you made an appeal to the High Court, and the High Court has directed the government to give you refund of 3 lakh rupees. So, you have got refund of 3 lakh rupees from the government. Now it is your duty to give that back to the customer, because GST ultimately belongs to the customer. Now, if CBDT is giving, CBIC is giving you some kind of a refund on GST, you should give it to the customer. So you received 3 lakh, but you paid only 2 lakh rupees to the customer. 1 lakh is still not paid. So 1 lakh you have to add it back. Okay. After that, you will compute your tax. Tax is very simple. 30% tax, as I have told you, last to last year turnover is more than 400 crore. 7% surcharge because the income is more than 1 crore rupees, and 4% cess will be imposed on you. Okay. Now coming to the next question. It's a beautiful question. Pay attention, please, all of you. This is the partnership firm whose gross total income is 300 lakh rupees. Okay. Now this firm has not done any international transaction or any specified domestic transaction. Therefore, this firm is not liable for transfer pricing. Okay. Now, in this 300 lakhs GTI, the firm has a profit of 200 lakhs from a business which is covered under 80IA. So 80IA is eligible for 100% deduction for first 5 years, and after 5 years the deduction reduces. Now this is the 5th year of business, therefore assessee will be eligible for 100% deduction. Now there is a problem over here. There are some gray areas in the taxation working, and the company is contemplating that they will file the return on 7th of December 2024 after seeking clarification from the expert. Advise the company what would be the total income and tax payable if they file the return on 31st October, which is on time, and if they file the return on 7th of December, which is late. Okay. So now we need to answer two things. If the company files the return on time, then what will happen? If the company files the return late, 31st October is the correct time, because partnership firm having 300 lakhs as gross total income, definitely liable for tax audit, and therefore liable for tax audit, then the due date is 31st October, not engage in any kinds of international transaction, therefore transfer pricing is not applicable, therefore 30th November is not possible. Now, let's assume that if the assessee files on 31st October, then what will happen? If the assessee files on 31st October, believe me, then the assessee is eligible for deduction under 80IA. 80IA, 80IB, all profit link deductions including 10AA is allowed only if you file the return on time. If you file a late return, then it is not allowed. Therefore, if you want this deduction, you should file the return on time. Therefore, if the assessee files the return on 31st of October, assessee would be eligible for deduction. And how will the assessee be computing the income? Listen carefully. The gross total income is 300 lakhs. Out of that, 200 lakhs will be allowed as deduction. 100 lakhs will be the total income. On 100 lakhs, tax will be 30%, 4% cess. Surcharge will not be imposed on the assessee, because surcharge is applicable to partnership firm if the total income exceeds 1 crore rupees. In this case, it is exactly 1 crore. Therefore, this is first calculation. But at the same time, it is a partnership firm and claiming deduction under 80IA. Therefore, it will also be applicable for what? AMT, 115JC. Therefore, we need to compute 115JC also now. How will we compute adjusted total income? Whatever is the total income, that is 1 crore, add back the 80IA deduction, that is 200 crore, 200 lakhs will be added back. Okay. Therefore, the assessee's adjusted total income will come to how much? It will come to 300 lakhs. On 300 lakhs, you will apply 18.5% tax plus 12% surcharge now, because the adjusted total income is more than 1 crore, and 4% cess. Okay. And down you will compare whichever is higher will be your tax liability. This will be your first tax calculation if you file the return on 31st October. Okay. Now, if you file the return on 7th of December, then you are not going to get the deduction of what? Deduction of 80IA. And if you are not going to get the deduction of 80IA, you are going to make only one calculation. That is normal provision. The concept of 115JC now will not arise, because 115JC will be applicable only if you claim the profit link deduction. So if you file the return on December 7th, then in that case, 115JC is not applicable, because you are not eligible to claim 80IA. Then your total income will be directly 300 lakhs. On that, 30% tax, 12% surcharge, 4% cess. Obviously, the second case, if you file the late return, the tax liability will be more. You can go and check. Now, we need to give them some advice. The sincere advice that I can give them is, you need to file the return. You please file the return on 31st October. And if you know that you will not be able to file correctly, then you can revise later on. But at least file the return on 31st of October, and then you can revise the return later. Revised return steps into the shoes of the original return. It will be deemed to be considered as filed on time. Okay. So don't worry about it. I hope it is clear to all of you. Now, the next question is on POEM. There is a company which is incorporated in Singapore, and 55% of its shares are held by an Indian company. Now, what is the question over here? We need to find out the residential status of this Singtel Limited. Okay. Now, to determine the POEM of and to determine the residential status of a company, we need to find out the active business is outside India or not. If active business is outside India, then the POEM is outside India, and if the POEM is outside India, then the company is non-resident. Now, to become active business outside India, there are 4 conditions which we need to follow, plus one additional condition is there with respect to board of directors meeting. The first 4 conditions are monetary conditions where we need to compute some percentages. The very first condition is the passive income should be less than equal to 50% of total income. Now for that purpose, we need to find out what all passive incomes are there. Now the first income is passive income. You are purchasing from associate enterprise and selling to unrelated party. Is it passive income? No. Passive income includes when you purchase from associate enterprise and sell to associate enterprise, then it is a passive income. This is not a passive income. Second one is also not a passive income because you are purchasing from associate enterprise, selling to unassociated enterprise, not a passive income. Where both purchase and sales are from associate enterprise, then it is a passive income. Therefore, this is passive income, this is passive income, and interest, dividend, royalty, capital gains, and your one more item is there, and rent. These 5 incomes are also passive income. Therefore, interest and dividend is also passive income. Therefore, this 5 lakhs, this 10 lakhs, why it is passive? Because it is purchased from associated, sold to associated, therefore it is passive, and this 20 and 15 is also passive. So, make a total of all of them and divided by the total income. What will include total income? Total income will include 25 lakhs, 50 lakhs, and then this 20 lakhs, and then 50 lakhs. Therefore, passive income is 50 lakhs, total income is 110 lakhs. Therefore, your passive income is less than equal to 50% of total income. Condition number 1 is fulfilled. What is condition number 2? The assets in India should be less than 50% of total assets. What are the Indian assets? These are Indian assets. These 3 are Indian assets. What are the total assets? These are total assets. Therefore, Indian assets comes to 210 lakhs and total assets come to 610 lakhs. Again, it is less than 50% of the total assets. Okay. Third one, the Indian employees. The Indian employees should be less than the total employees, 50% less than the total employees. So therefore, Indian employees are 70, total employees are 160. Therefore, Indian employees are less than 50% of the total employees. And the expenditure, payroll expense on the Indian employees should also be less than 50% of the total expenditure. Therefore, the Indian expenses, the payroll is 80 and the total payroll expense is 20. Therefore, that is also less than 50%. That is 40%. Therefore, these 4 conditions are fulfilled. Now, one last thing has to be checked. Where are majority of the board meetings held? The majority of the board meetings should be held outside India. So there are 8 board meetings held by the company, out of which majority 5 were held in Singapore, only 3 were held in India. Therefore, majority of the board meetings were held outside India. Therefore, with that logic, the assessee is a non-resident, non-resident, and non-resident. I hope it is clear to all of you. So this is what this question is all about. Okay, let's go ahead with the next question, which is a very simple question on charitable trust. There is a charitable trust who is registered under 2LAB, and it has derived an income of 21 lakh rupees. How 21 lakh rupees is derived? 10 lakh rupees from property, 4 lakh rupees from business, and 7 lakh rupees from public as a contribution. Therefore, you have to add all of them and you have to claim 15% exemption out of it. Okay. Now, whatever you have received from that, you will get 15% exemption if you are an eligible trust. Now, whatever you have applied 11.6 lakh rupees. But this includes loan taken for construction of construction of orphanage of 3.6 lakhs. Okay. But whenever you have taken the loan, and at that time when you have incurred the expenditure, that was allowed as an application. So for example, 2-3 years back, you have taken a loan of 3.6 lakh rupees, and with that loan you have incurred an expenditure, and at that time you have claimed that deduction. Okay. Therefore, that much amount will not be allowed as deduction in the current year. Okay. Therefore, out of 11.6 lakhs, 3.6 lakhs is already claimed as deduction earlier. Therefore, only 8 lakhs will be allowed as deduction. So, remove that and then you can claim what? You can claim the differential amount will be taxable in the hands of the charitable trust. Okay. I hope it is clear. Why 3.6 lakh is not allowed to reduce? Because that is already allowed as deduction earlier year. Okay. And in earlier year, it was allowed also. Now, there is a rule of law which says that if you take a loan and incur an expenditure, then it is not allowed. It is only allowed on repayment. But earlier, before 2021, it was not like that. Before 2021, if we used to take a loan and if you used to incur an expenditure, then that expenditure was also allowed. There was no need to repay that loan. Okay. I hope it is clear to all of you. Next question is the advance ruling includes within its scope a determination of board for advance ruling in relation to a transaction undertaken by non-resident applicant. Is it true that only a non-resident can go for advance ruling? Wrong. A non-resident can go for advance ruling, but only a non-resident can go for advance ruling. It is not correct. A non-resident can go for advance ruling. Even a resident can go for advance ruling when it enters into a transaction with non-resident. Even a specified resident whose transaction value is 100 crore or more can also go for advance ruling. Even a public sector undertaking can go for advance ruling, and even a person who is engaging into any kind of GAR transactions which will be subject to GAR, they can also go for non-resident. They can also go for advance ruling. Okay, so it is wrong to say that only and only one person can go for advance ruling. Okay, let's move on to the next question. We need to identify whether the two enterprises are deemed to be associate enterprise or not for the purpose of transfer pricing. In first case, one entity has given a loan of 170 crore to another entity whose book value of assets is 300 crore. Now remember, if one entity finances 51% of the book value of the total assets of the other entity, then both of them are deemed to be associate enterprise. Market value is not relevant. What is relevant is book value, and how much is repaid in the current year in the form of loan, that is also not relevant. At any time during the previous year, if it is 51%, then both of them are deemed to be associate enterprise. The book value of asset is 170 crore. The loan is 170 crore. The book value of the asset is 300 crore. Therefore, it is more than 51%. Therefore, both of them are deemed to be associate associate enterprise. Next one is when one entity that appoints more than half of the directors of the other entity, then both of them are deemed to be associate enterprise. In this case, you can check out of the 8 directors, the one entity is appointing 3 of the directors of another company. Therefore, it is not more than half of the directors. 3 out of 8 is not more than half. Therefore, both of them are not deemed to be associate enterprise. Third one, if one entity depends on the other entity for raw material of up to 90% or more. So, if I am dependent on you for raw material of 90% or more, then we both are deemed to be associate enterprise. Now, I have purchased a total raw material of 900 crores, out of which you are giving me raw material of how much? 830 crore, which comes to 92.22%. Therefore, both of them are deemed to be associate enterprise. I hope it is clear to all of you. Next question is on search and seizure. A very important question. Cash is seized of 25 lakh rupees on 12 September 2023. So now there is a provision in the law which says that whenever the government seizes your any assets in search and seizure, you have an option under proviso to section 132 where you can go and explain the nature and source to the income tax department within 30 days from the end of the month. So if you go within 30 days from the end of September, that is still 30th October 2023, explain the nature and the source to the income tax department, and if they are satisfied with your explanation, they will reduce the existing liability and give you the remaining asset within remaining money within 120 days from the date of search. So you went to the income tax department on 27th December for release of your assets, but the income tax department turned down your assets, turned down your application. It means they did not consider your application and they said that we will not give you anything. Can they do so? Can the department withhold the explained money? Yes, why not? They can withhold the explained money. Yes, you have gone to the department on time. Within 30 days from the end of the month in which the asset was seized. You should have gone till 30th October. You have gone on 27th October. You have gone before time. But it is at the discretion of the officer whether he will like your explanation or he does not like your explanation. If he does not like your explanation, he can turn down the application. It's all allowed. If yes, to what extent and up to what period? Yes, he can keep this money up to 120 days from the what? So first of all, can the department withhold the explained money? Yes, they can withhold the explained money. Yes, up to which date? If it is explained, then they can withhold up to 120 days from the date of the search. Okay, I hope it is clear to all of you. Now, next question is again a very good question on section 292BB. Read with section 143 subsection 2, that is scrutiny notice. TIE Limited filed its return of income on 26 September. Now, if a person has filed the return of income, by when the department should serve the scrutiny notice? The scrutiny notice should be served within 3 months from the end of the financial year in which the return was furnished. So the return was furnished on 26 September 2023. So within 3 months from the end of this year. So within 3 months from the end of this year comes to which date? It comes to 30th June 2024. But the assessee was served the notice on 3rd July 2024. Okay. Now the question is, the assessee has received a late notice. Then what is the obligation of the assessee? The obligation of the assessee is to challenge the validity of the notice right now itself before the completion of assessment. But if the assessee challenges the validity of the notice after completion of the assessment, then in that case it will be called as what? It will be called as deemed to be valid. So if you get a late notice or an improper notice, you should challenge before passing of the assessment order, not after passing the assessment order. But if you cooperate and after that the assessment order is passed and now you are challenging, then the department is not going to accept your plea and they will say that it is deemed to be valid as per section 292BB. Next one is a theory question on tiebreaker rule. Very important theory question, but you go through at your end. It's a very simple question, nothing great as such. Okay. Now question number 6A. There is an assessee who has received some cash loan from a particular person. Now the assessing officer says that, no, I do not believe the story of loan. This is not loan, but this is an income of 50,000 rupees from undisclosed source, and then the assessee imposing penalty under 271D of 60,000 rupees. Whether the assessing officer is correct. Assessing officer is incorrect at multiple places. First of all, when I am receiving the money, I am saying it is loan. Officer is saying no, it is not loan. It is undisclosed money. It is undisclosed income. Okay. If it is undisclosed income, then how can you impose 271D? 271D is imposed not on income. It is only imposed in case of 269SS. If there is a loan which is taken in cash. Now, if you are taking this is not, if you are saying that this is not a loan, then you cannot impose 271D. Even if you impose 271D, 271D cannot be more than the amount of loan. The loan is 50,000 rupees and you are imposing 60,000 rupees. So there are multiple mistakes which are done by the assessing officer. Therefore, the assessing officer is not correct in this case. The next question, both of them we have already done earlier. Don't worry about it. And the next question also, it's a simple question on DTAA. You can go through it once. It's there are 2 countries over here instead of 1 country. Instead of 1 country, you have to compute DTAA for 2 countries. Apart from that, nothing else is there in this particular question. Okay. So I hope it is clear to all of you. So this is what this MTP is all about. So let's move on to the next MTP, that is MTP Series 1, November 2023. Now the very first question, which is on total income, is exactly similar to what we have done earlier. All the adjustments over here is exactly copy paste. You can check all of them if you want. Exactly copy paste. Not even a single adjustment is new. So let us not waste time on this. Let's move on to the next question, which is a very beautiful question. Question number 2, both the parts, there are two parts, part A and part B. Both of them are excellent part. Okay, let's complete the first part. First of all, that is, there is a cooperative society which is engaged in marketing of agricultural produce grown by its members, and they have earned a profit of 65 lakh rupees. Therefore, this cooperative society is eligible for what? Deduction under ATP. Okay. Now, any cooperative society which is engaged in marketing of agricultural produce grown by its member is eligible for section ATP. Apart from that, the cooperative society has also employed 10 employees with an emolument of 22,000 rupees, which is less than 25,000 rupees on 1st of May. Therefore, it is more than 240 days and it is paid by account paycheck. Therefore, it is also eligible for 80 JJAA deduction. The cooperative society is eligible for audit. Yes, it is mandatory that if you want 80 JJAA, then you should be eligible for audit. It also earns fixed deposit interest of 30 lakh rupees. Compute the tax liability and income of, and advise whether it should opt for the special provision under 115 BAD. Now, we need to make two calculations over here. First calculation, as per option 1, we will do normal calculation. Option 2, we will do 115 BAD. In option 1, when we are doing normal calculation, in that also we have to do two calculation. One as per regular provision and one as per AMT. Now, let's compute in option 1 as per regular provision how we will compute the income. 65 lakhs is your profit from your ATP, and then another 30 lakhs you have earned from where? And you have earned from interest. Okay, then you will get in regular provision, you will get ATP deduction, you will get 80 JJAA deduction also. Both the deduction will be available to you, and then you will compute your total income and tax liability. Tax liability as per regular provision will be up to 10,000 10%, about 10,000 20%, and about 20,000 it is 30% income tax will be imposed on you, and surcharge and cess if applicable will be imposed on you. Now, under the normal provision, the second calculation which you have to do is as per AMT, but remember AMT is not applicable on ATP income. So while computing the adjusted total income, you will only add 80 JJAA, you will not add ATP. On ATP income, AMT is not applicable. Therefore, add 80 JJAA, compute adjusted total income, take 18.5%, add not 18.5%, sorry, for cooperative society it is only 15%. So therefore, add 15, take 15%, and then surcharge if applicable and cess, and this whichever is higher will become your tax calculation number 1. Now, tax calculation number 2 will be an alternative tax regime under 115 BAD. Under 115 BAD, remember, you will not get the deduction of ATP, but you will get the deduction of 80 JJAA. In 115 BAD, ATP is not allowed. Therefore, here ATP will be added back and 80 JJAA will be allowed to you, and then you will compute your tax as per 22% tax is applicable under 115 BAD. So remember, very, very dangerous. Huh? In AMT, ATP is allowed, but in 115 BAD, ATP is not allowed, and vice versa. Okay, and here 80 JJAA is not allowed, and there 80 JJAA is allowed. Then compute your tax, 22% tax, 10% surcharge, 4% cess. That will be your tax liability, and then see whichever is more beneficial. Okay, now the next question is also a beautiful question. Multiple incomes are earned by assessee. There is a person, Mr. Charles, who is a non-resident. He is a German citizen and non-resident as per the income tax law, and he is working in a German company. Now that German company has a PE in India. Now that German company has a PE in India, and they are sending this person, that is Mr. Charles, to India for some official work, and he has stayed in India for 85 days, and during this period he has earned a salary of 28 lakh rupees, and that German company has charged that 28 lakh rupees to Indian PE. It means they have taken deduction of that 28 lakh rupees in the Indian branch. So therefore, whether this German citizen will be exempt from salary income, whether he will get an exemption under section 1066. Do you remember that if a foreign citizen comes to India who used to work in foreign enterprise, and if he renders services in India and if he earns salary, then it is exempt subject to some condition. Condition number 1, he should stay in India for up to 90 days. Condition number 2, that foreign company should not have any branch, that should not have any trade or business in India, and that foreign company should not charge that expense as that foreign company should not take deduction of that expense in India. So therefore, the assessee is not fulfilling all the condition. The foreign company should not have any trade and business. This German company has a business in India. Therefore, this exemption is not available to the assessee. This 28 lakhs will be chargeable to tax. From that, you can claim 50% deduction, 50,000 deduction, standard deduction you can claim. This exemption under 1066 is not available. Okay, I hope it is clear to all of you. Next, income which he is earning, he has purchased some shares of Indian company in foreign currency. He has remitted foreign currency. So now, whenever a non-resident purchases shares of Indian company in foreign currency, then the proviso to first proviso to section 48 will apply. Then you have to convert all the calculations into dollar, then again into rupees. How will you calculate? Sale consideration and expense on transfer will be converted based on average of TTBR and TTSR on the date of transfer, and cost of acquisition will be converted based on average of TTBR and TTSR based on date of purchase. and then whatever the long-term or short-term capital gains will come, that will be reconverted into INR as per TTBR on the date of purchase. Okay, TTBR on the date of sale. This is how we are going to calculate in this particular case. Okay, third case, third income which is earned by this particular person. Charles also holds some shares of a foreign company. Now this is a case of Vodafone case law. This foreign company Aarish GmbH, it is like CGP. Charles hold the shares of this CGP company like Aarish GmbH, and then these shares were acquired for 145, and now Charles is selling for 615 to another non-resident. Whether capital gains will be chargeable in India? The answer is no. The shares of AG, that is Aarish GmbH, does not derive its value substantially from asset located in India. Why so? How did you come to know? Because substantially derived from asset located in India means the assets in India has to be at least 10 crore rupees. Now this company only has an assets of 8 crore in India. Therefore, I am not checking the second condition also of 50%. There are two conditions we have to check. The Indian assets have to be at least 10 crore and it has to be 50% of the total assets. So 50% I am not checking only because first condition itself is violated. Therefore, the shares of this company is not liable to capital gains in India. Last but not least, Mr. Charles has received a dividend from Aarish in India. Unfortunately, the dividend is received in India, therefore it will be taxable. If it would have been received outside India, then it would have not been taxable. Now, because it is received in India, it is taxable under the income tax law. So this is what this beautiful question is all about. Next question is a theory question. Advance rulings has the power of compelling the production of books of account? The answer is yes. Advance ruling has all the powers which are given under section 131, that the powers to issue summon, and under section 131, one of the power is to compel the production of books of accounts. That power is there with the advance ruling authority also. Okay. The next question is on equalization levy. There is a non-resident PQRINC. That non-resident does not have a P in India. There is another non-resident NR. This non-resident also does not have a P in India. And this first non-resident is giving to a second non-resident online advertisement service. Therefore, online advertisement service should be first tested under 2016 equalization levy. But in this case, 2016 equalization levy is not applicable because the recipient has to be either resident or the recipient has to be non-resident who has a P in India. In this case, the recipient is a non-resident who does not have a P in India. We have done a similar question earlier. Therefore, 2016 equalization levy is not applicable. But whether 2020 equalization levy can be made applicable? Yes, it can be made applicable if the services in India are more than or equal to 2 crore rupees and it is to target Indian customers. Similar adjustment we have done earlier in case of Turnip and Sam INC, if you remember. So therefore, here PQRINC, who is a non-resident, it does not have a P in India, providing services of 3 crore rupees in India, which is more than equal to 2 crore rupees, and we are also providing services to what? For targeting Indian customers. Therefore, 2% equalization levy will be applicable on 5 lakh rupees because it is to target the Indian customers. I hope it is clear to all of you. Next question is a very simple question on TDS. Let's talk about that one by one. An Indian company is paying some salary, including allowances and monetary perquisites of 7,30,000 to the employee. So 7,30,000 will be added to the income. Apart from this, the company is also giving some perquisites of 1,20,000. So that will also be added to the income. So total will be 8,50,000. From that, the assessee will get 50,000 standard deduction, and then the company will deduct TDS as per the old regime, because it is written that the company manager is not opting, employee is not opting for 115 BSE. Therefore, follow the old regime. Okay, and compute the tax. Next one is a very simple question once again of NR taxation. There is an infrastructure debt fund. Remember, if infrastructure debt fund takes a loan from a non-resident and pays an interest, then 194 LB is applicable, and as per 194 LB, the TDS will be deducted at 5.2%, 5% tax, and 4% cess, 5.2%. But if the other person is a person located in NJ, then section 94A will apply, and in case of NJ, I will deduct TDS at how much percentage? I will deduct TDS at 30%. Okay, how much percentage? 30%. So in normal case, if the person is not located in NJ, I will deduct TDS as 5%. If the person is located in NJ, I will deduct TDS at 30% plus 4% cess. Okay. The next question is, I am telling a contractor that I want to make a product according to my specification and I will give you the goods. Okay. So I am telling you that you will make a shirt for me, you will stitch a shirt for me, and the cloth will be given by me. In that case, if you give me the breakup, 194C is applicable because you are providing me service, because you are purchasing the material from the customer itself. Okay. So in that case, 194C is applicable. Now there are two possibilities over here. If you give the breakup in the invoice that this much is this much is this, then I will deduct TDS only on the service portion. But if you don't give the breakup, then I will deduct TDS on the entire portion. Okay. If breakup is given, no breakup is given, these are two perspectives which are there. Next, last one over here. you are making some 5 lakh rupees payment to a commentator, though therefore it is a professional service. Commentators come under professional service, therefore TDS will be deducted under 194J at the rate of 10%. Okay, 10% TDS will be deducted under 194J. I hope it is clear to all of you. Next question, question number 5A is a very good question. There is a CIT who issues notice to the assessee, to the AO, that I want to revise your order under 263. Therefore the AO has passed an order under 143. Now the CIT wants to revise that order. Okay, now after some time the CIT, the survey was conducted in assessee premise. Listen carefully first. First of all, I am a CIT, you are an assessing officer. You have done some assessment. Now I am sending a notice to assessee and also to the AO that I want to do in revision under 263. Then after some time, there is a survey under section 133A. Now I am sending you second notice. The content of the second notice is far different from the content of the first notice. Is the Commissioner of Income Tax allowed to send a second notice where the content of the second notice is very different from the content of the first notice? The court has said that it is not allowed. The court said that the Commissioner cannot change its opinion based on what? The new notice. Okay, it has to stick to whatever was written in the first notice and revise the order. The Commissioner cannot change the order in between based on the second notice. Second one, the Director General of Income Tax has got some information that you have some unaccounted cash of 50 lakh rupees. Therefore, the DGIT, the Director General of Income Tax, has some information that you have a cash of 50 lakh rupees unaccounted cash. Therefore, it has issued orders under 131 for seizure. Is it a valid order? Not a valid order. 131 is not for seizure. 131 is only for issuing summon. And in case of summon, you cannot seize anything. If the Director General wants to seize this particular item, he has to issue a search warrant under section 132, and search warrant can be issued by 8 income tax authorities, that is Director General, Director, Chief Commissioner, Commissioner, Additional Director, Additional Commissioner, Joint Director, Joint Commissioner. These are the 8 authorities who have the power to issue search warrant. With the help of 131, you cannot seize any item of the assessee. Okay. Next question is a very simple question on DTAA. Just keep one thing in mind. The assessee is 63 years old. Therefore, the insurance premium will be allowed to the extent of 50,000 rupees. Okay. Don't worry about it. 80 TTB will also be allowed. And one important thing, the assessee is purchasing some 4-year fixed deposit in the name of her son. So in the name of her son, if the assessee purchases a fixed deposit, then the deduction under ATC is not allowed, not allowed, not allowed. Okay. I hope it is clear to all of you. And one last question in this particular MTP is question number 6. There is an NBFC. Can NBFC accept 20,000 or more in cash through a loan? Not allowed. Only banks, only cooperative bank, post office can accept 20,000 or more in cash. NBFCs cannot take, otherwise 269 SS will apply. Okay. Now, the individual has deposited 15,000 rupees by bearer check. Is it allowed? It is allowed. Up to 20,000, less than 20,000 rupees by bearer check is allowed. But when it deposits the another 15,000 by cash, at that time 269 SS will apply. Why? Because the provision says that on the date of taking the cash loan, on the date of taking the cash loan, that is the second loan, if there is an outstanding amount, so then outstanding amount and this cash loan, the outstanding of earlier and this cash loan, the together also should not be more than or equal to 20,000. So in second case, 269 SS will apply, and therefore 271D penalty will be imposed on the NBFC. Now, the assessee is what? The NBFC is repaying this. First is repaid by 16,000 rupees, 500 by bearer check. Not allowed, because 269T says that if there is an outstanding of 20,000 rupees or more in your balance sheet, then you cannot repay a single rupee in cash or bearer check. You have to repay by account pay check, account pay draft, ECS or such as electronic mode. So there is already an outstanding of 30,000 rupees and you are repaying 16,500 in cash. 269T will apply, 271E penalty will be imposed. Now, after the first repayment is done, now the outstanding is only 15,500 rupees. Now, if you want to repay that in cash, that is allowed, because on the date of repaying 15,500, your outstanding is not more than or equal to 20,000. So this is allowed. The first one is not allowed. So this is what this paper is all about. Okay. So let's go on to the next MTP, that is MTP Series 2 November 2023, and the very first question over here is exactly similar with same numbers, everything is same, as exactly similar to question number 24 of RTP. Again, ICI has repeated with the same number. They don't have questions now to ask in the examination also. They are repeating same questions again and again. So just try to understand that even the exams are going to be somewhat similar to this only. There are a lot of questions which are going to be repeated out of this compilation of 23 papers which I have done. 8 RTPs, 7 past papers and 8 mock test papers. Most of the paper is going to be repeated out of this only. Okay. Now, therefore, this question I'm not interested. Exactly similar question. Just go through it or else leave it exactly. I have already put the reference also which question it is similar to. Okay. Question number 2. Let's start with this question. Question number 2. The assessee is a partnership firm and it has a profit of 80 lakh rupees. You are supposed to compute the total income of the partnership firm. under the normal provision, you are not supposed to follow AMT and all. Don't follow AMT and all. Just follow the normal provision. Okay. Now, whenever you compute partnership firm's total income, now the very first thing that we are supposed to do in case of partnership firm is you have to compute the book profit of the partnership firm. After we compute the book profit of the partnership firm, then we compute the remuneration allowable to the firm, and then we compute the total income and tax liability. Okay. In this question, they have not asked to compute the tax liability, only the total income. Therefore, first of all, we will compute book profit, and then we'll compute the total income of the partnership firm. While computing the book profit, you have to be very careful. What is book profit? Book profit is nothing but PGBP income only. Net profit as per PNL, all effect from section 28 to 44, and then if remuneration is debited to PNL, you have to add it back to the PNL account. Okay. So let's see one by one. The very first thing, the profit is 80 lakhs. The partnership firm is paying interest of 13% to the partner. Therefore, how much is allowed under the income tax law? Only 12%. Therefore, 1% has to be disallowed. Similarly, the partnership firm is paying interest on loan taken from partner at 15%. Interest on loan is also covered in 40B. Therefore, 12% is allowed. You are paying 15%. Therefore, 3% will be disallowed under the income tax law. Next, the partnership firm is earning some interest on fixed deposit. Now, this is not a part of PGBP income. Therefore, reduce from here and show under what? Show under IFRS. Then, depreciation as per books of accounts will be added back. Okay. Now, the next adjustment is a beautiful adjustment. This is something new. You have to be very careful with this adjustment. The company has purchased a building in 2019, not company, the firm. The WDV of the building today is 36.45. Now it is sold after 3 years for what? For 90 lakh rupees. Now, and the differential amount is credited to PNL. First of all, if you have purchased a building 3-4 years back and now you are selling, that building is a depreciable asset. Now, whatever profit is there, you are crediting to PNL. That is wrong. The profit does not deserve to go to PNL. The profits will be going to the capital gains head. Okay. Therefore, first of all, you have to reduce the differential amount. 90 minus 36.45, whatever is the profit, reduce from PGBP income. And then go under what? Under the head capital gains and compute capital gains in case of transfer of block of asset. Okay. Now, this is a block of asset. When did you purchase this asset? In 2022, in 2019. And when are you selling this? You are selling at the end of 2022. It means you are selling after 24 months. Okay. This has a very important relevance in the question. You will come to know in a while what relevance does it have. Now listen carefully, please, all of you. So therefore, now we will compute the capital gains over here. The capital gains will always be short term under block. Therefore, 90 lakhs is the sale consideration and your 36.45 lakhs is your WDV. Therefore, differential amount something around 53.55 will be called as your short term capital gains. But the gain is short term. The asset is not short term. The asset is more than 24 months old. Therefore, the assessee is eligible for exemption under 54EC. Do you remember that or not? As per the Ace Builders case law or Dempo Limited case law, it was held that the asset in the block may be short term, may be long term, but the gain is always short term. Therefore, if the asset is long term, then you are eligible to claim 54EC exemption. Here, you have purchased the 54EC investments of 60 lakhs on 5th of April, which is within 6 months. But the bonds were issued after 6 months. So what matters is when you have invested. It doesn't matter when the bonds were issued. Listen carefully. 10th of October, you have sold the asset. Now, within 6 months, you are supposed to invest in the new bonds. Okay, in the bonds of NHAI, RECL, etc., etc. So you have invested 60 lakh rupees on 5th of April, which is within 6 months, but the bonds were issued after 6 months. It doesn't matter. The bonds can be issued at any time. What matters is when you have invested in the bonds. Are you investing within 6 months? The answer is yes. You will get the deduction. Okay, but how much? Only 50 lakh rupees exemption will be allowed to you. That is a very important point to be kept in mind, because in 54EC, you do not get exemption of more than 50 lakh rupees in a financial year. Okay, so this is a very, very important catch which we are going to see in the capital gains head. Right now, we are computing the book profit. While computing the book profit, we are not going to do all these things. While computing the capital gains, yes, you have to do all these effects. Next one is there are 4 partners, but out of that, only 2 partners are working partners. And you are paying a remuneration to them at the rate of 20,000 rupees per month, okay, and which is not debited to PNL. So if it is not debited to PNL, we don't have to add back anything. If it would have been debited to PNL, I would have added back this remuneration. Okay, now this will be helpful to compare with the maximum limit, and whenever the maximum limit will be there, we will compare that with 4,80,000. How did I get 4,80,000? 20,000 into 12 into 2 partners. Okay, next one is very, very, very important. That is point number B. I'll discuss at the end of the discussion. Next, depreciation of 14,000. You're going to claim that depreciation on that. Next, WDV of the motor car which was purchased in 2020. Remember, if any motor car is purchased and put to use from 23rd of August 2019 to 31st of March 2020, then you will get 15% extra depreciation. Therefore, on this WDV, you are not going to get 15% depreciation. In fact, you are going to get 30% depreciation. Cell phones which are purchased in the current year and put to use for less than 180 days, you will be getting 7.5% depreciation instead of 15%. And one last thing which is going to be here, that is 10AA deduction. You will compute at the end of chapter 6A. Okay, 10AA is very simple. 7.5 lakhs is your net profit, and multiply by export turnover is 40 lakhs, divide by total turnover is 120 lakhs. But sir, you have said in the class that 10AA is only available if you start your operation before 31st March 2020. Yes, I have said that, but I have I've also said one thing, that if you have got the letter of approval till 31st March 2020 and then if you commence the operation till 31st March 2021, then also it is available to give benefits in case of COVID cases. Because of COVID, lot of people got the letter of approval before 31st March 2020, but they were not able to start the business by 31st of March 2020. So the government has given an extension to those people who have already obtained the letter of approval. They can start the business till 31st March 2021. Okay, so assessee has done that. Therefore, assessee will be eligible for this particular benefit. After doing all this thing, just compute your book profit, and after computing the book profit, just compute the total income, and then tax liability is not asked, so don't compute the tax liability. Okay, the next question is a simple question on DTAA. I'm not interested in that question. It's a very straightforward question, so don't waste much time on that question. Let's come to the next question, which is a question on exit tax. There is a charitable trust which was formed, which has whose balance sheet on 31st Jan 2024 is given to us. Okay, now the charitable trust was registered in 2013. It made an application for registration in 2013 April. It got registration from on 1st of July 2013. Okay, so application was made in April 2013 and the registration was granted in July 2013. Okay, now listen carefully. But the trust was started much before that. The trust was started much before that. Okay. Now, we need to compute the exit tax. Why? Because on 31st of Jan 2024, the trust registration was cancelled. Okay. So, because the trust registration was cancelled, now the trust is no more a trust. They have to pay accredited income tax. How much tax? 34.944% tax on accredited income. How to compute accredited income? All the assets of the trust minus all the liabilities of the trust computed in the prescribed manner. Rule 17 CB. What does Rule 17 CB says? Let's see. All the assets minus all the liabilities. First one, land. Land you will not take. Why? Because it was purchased before registration. Any asset which was purchased or any liability which was incurred before the registration shall not be included in the accredited income. Only assets and liabilities which are incurred after the registration shall be included. Second one, but land building purchased in 2017. The book value is 800 lakh. What is the value that we are going to take? You should take the book value, you should take the market value or the stamp duty value, whichever is higher. So the market value is 1000, stamp duty value is 1050, therefore you will take 1050. Okay. For listed shares, you will take the average of the highest and the lowest on the date on which the trust was cancelled. Okay, the trust registration was cancelled on 31st Jan. So on 31st Jan, the highest value was 1099, the lowest value is 1051. Take the average of that. On as per that, you will value it. Then bank balance will be valued as per book value. Then scheduled bank fixed deposits will be valued as per book value. Cash in hand will be also be valued as per book value. Then capital fund is not included in the liabilities. That is not a part of liability as per Rule 17 CB. Then creditor 335 is the total creditor, but there is some problem in that. Out of that, 30 rupees creditor is provided on estimated basis for which no bills are received. So this is contingent liability. It is not final liability. It is not crystallized. Therefore, you are not going to take this 30 rupees over here. Only 335 minus 30, that is 305, is the liability that you are going to take. Then compute accredited income and compute the tax, as simple as that. The tax rate over here is 34.944%. The next question is also a new kind of question, a very important question, very good question for the examination. There is a foreign company who has a branch in India. So now, if a foreign company which has a branch in India and if the head office allocate some expenses in India, how much expenditure will be allowed to that head office, that branch in India? It will be allowed as per section 44C. And what then 44C says that? 44C says that 5% of the adjusted total income subject to the actual amount allocated in India, whichever is lower will be allowed as deduction. Okay. Now what is adjusted total income? The company has given us a net profit of the Indian branch, which is 28 lakhs and which is after charging the following expenses. After charging the following expenses. Now we need to compute the adjusted total income. We need to take 5% of that and then compare the actual expenses allocated. What is adjusted total income? Adjusted total income is nothing but total income plus few items, okay, which are reduced. All those items which are reduced from the profit, which has reduced from the total income, you have to add back few things. Which all things I have to add back? Am I supposed to add the current year depreciation? No. Current year depreciation is not added back. Am I supposed to add back the unabsorbed depreciation? Yes. Go and see the formula of adjusted total income for the purpose of 44C. That is, for unabsorbed depreciation is added back. Am I supposed to add the capital expenditure of family planning? Yes. Capital expenditure of family planning is added back. Am I supposed to add the current year expenditure of scientific research? No. That is not added back. Loss is also added back. Chapter 6 is also added back. And head office expenses already allocated to the P&L will also be added back. You will add back all these things. You will get adjusted total income. Take 5% of that and then compare with 120 lakhs. Whichever is lower will be allowed as deduction to you. Okay. That much deduction will be allowed and then accordingly compute the total income of the SSE. I hope it is clear to all of you. The next question, question number 4. In this, the first part is already done by us. It is exactly similar to question number 28 of RTP. It is copy paste. You can go and see the question number 28 of RTP discussion which we have done. It is exactly similar to that. So we will not waste time on that. Let's move on to the next question. We need to identify whether the following persons are liable to file the income tax return or not. Let's see the first person. A person who has a business turnover of 70 lakh rupees. Remember, any person who has a business turnover of more than 60 lakh rupees, if a business turnover is more than 60 lakhs, or if the profession gross receipt is more than 10 lakhs, you are liable to file the income tax return. Therefore, by that logic, the SSC is liable to file the income tax return. Similarly, any person who has deposited 50 lakh rupees or more in a saving bank account, how much? 50 lakh rupees or more in a saving bank account is liable to file the income tax return. Therefore, this SSC is liable to file the income tax return. I don't want to read also other discussions. This is the sufficient reason for me to file the return. Therefore, SSC has to file the return. The next question is exactly similar to question number 5 of November 2022 past paper. You can go and check over there. Question number 5 of November 22 past paper. It is exactly similar to that question. Okay. So don't waste much time. One last question over here is question number 5 has two parts. The first part is a theory part. I'm not interested in that. The second part is a transfer pricing question, which is very important transfer pricing question. At least 4 to 5 times ICI has asked the same question in the examination, not in RTP, MTP. In the exam also ICI has asked this question at least 4 to 5 times. Since I am studying transfer pricing, I have seen this questions many times in the examination. Now, what is exactly there in this question? There is a company TOW Limited, which is in India, and there is a company TIC Limited, which is in Australia. The Australian company holds 30% in Indian company. Therefore, both of them are deemed to be associate enterprise. Now, the Indian company is providing some services, some providing some goods, and for that the cost is 3,50,000 rupees. We need to find out the arm's length price as per the cost plus method. As per which method? Cost plus method. Now, what is the arm's length price? How to compute arm's length price as per cost plus method? Remember, as per cost plus method, the very first step is the cost, the total direct and indirect cost which you provide. What is your total direct and indirect cost with respect to the services and the goods which you provide to your associate enterprise? So my total direct and indirect cost is 3,50,000 rupees. Okay, this is my total direct and indirect cost. Then I have to find out the GP margin in case of uncontrolled transaction. GP upon cost in case of uncontrolled transaction. The GP upon cost of uncontrolled transaction is how much? It is 40%, because TOW also provides services to GN Limited, which is an unrelated party, and it charges 40% cost to the unrelated party. Now, this 40% should be adjusted, because this 40% cannot be directly applied, because when I do transaction with my associate enterprise and I do transaction with unrelated party like GN Limited, there might be some functional differences which might be there. So because of the functional differences, the GP might go up, the GP might come down. Therefore, what are the functional differences between the two transactions? One is a transaction which I am entering into with my associate enterprise. Another is the transaction which I am entering into with third party. Therefore, what are the functional differences between the two? Point number 1, pay attention please. When I provide services to my associate enterprise, there is no such support from while also derives technological support from associate enterprise. When I provide services to my associate enterprise also give me some services. So please tell me, when I provide services to my associate enterprise also give me some technical support. But when I provide services to third party does not provide me any service. So please tell me to whom I will charge more GP and to whom I will charge less GP. Obviously, when I provide you service, you also give me something in return, so I will charge you less GP. When I provide services to third party, they do not provide me anything, so I will charge them more GP. We are starting from their GP 40%. So I am providing services to my associate enterprise. You are also giving me something in return. So that much GP might be reduced in my case. Therefore, how much services you provide to me? You provide me 10% of, 15% of the normal GP. What is my normal GP? My normal GP is 40%. What is 15% of 40%? It will come to 6%. Therefore, that much GP, I have to charge you less. Because when I provide you service, you also give me some service. So I have to charge you 6% lesser as compared to I charge to what? My third party. The second difference between both of them, when I provide you services, I offer you discount. Whereas when I provide services to third party, I don't offer any discount. That discount amounts to 10% of normal GP. 10% of normal GP will come to 10% of 40%, which will amount to 4%. So when I provide services to associate enterprise, I give discount. So if I give you discount, my GP has to be lesser. When I provide services to third party, I don't give any discount. Therefore, in that case, the GP has to be higher. So in my associate enterprise case, the GP has to be lower. So I have to reduce this 4% over here. I have to less this. Okay. Third one, when I provide services to TIC and TOW Limited, so there is no, when I provide services to my associate enterprise, there is no risk. There is no additional marketing cost that I have to incur. So when I provide services to you, there is no risk, there is no additional marketing cost. So if there is no risk, there is no return. Okay. But when I provide services to third party, there is an additional marketing cost. There is an additional risk. Therefore, high risk, high return. So when I provide services to third party, high risk, high profit. When I provide services to my associate enterprise, low risk, low profit. Therefore, in your case, my profit has to be lower. Therefore, it amounts to how much? 20% of normal GP. Normal GP is 40%. 20% of 40% comes to 88%. Therefore, I have to reduce 8% over here. Okay. And the fourth and the last one. When I provide services to you, listen carefully. I give you 1 month credit. When I provide services to third party, there is no credit. So when I provide services to you, I give you 1 month credit. So in that case, my profit margin has to be higher because I give you credit, I will charge you more. If I charge you more, my profit margin has to be higher. Therefore, in case of third party, I don't give any credit. Therefore, there the profit margin has to be lower because I will charge lesser to them. Therefore, how much that amounts to? That amounts to 5% of normal GP. 5% of normal GP amounts to 2%. So in my case, when I give you services, I am charging you. I will charge you more. Therefore, I have to now add back 2%. So first 3 items will be reduced. Fourth item will be less. That will give me arm's length GP. That arm's length GP I will apply on my cost of 3.5 lakh. That will give me my arm's length price. So this is what this paper is all about. Just go through it. And this last question is one of the most important question of this particular paper. So let's move on to the next paper, that is May 2024 mock test. That is the latest one, series 1 mock test. And the first question is a beautiful question. And this entire mock test is a beautiful mock test. Now, there is a company, Sheetal Limited, which is a listed company, which is engaged, which is in Mumbai. The books of accounts are maintained. There are 4 units in this company. There are 4 different businesses which are done by this company. So we need to consolidate the profit of all 4 and compute the PGBP income. Okay. And now at the end, what they are giving us, what we are supposed to compute? We are supposed to compute the total income of the company and optimum income tax liability. Optimum means we need to find out the total income as per the normal provision, the total income as per the special provision, and all those things, and we need to compare them, and then we need to find out whichever is more beneficial. Now listen carefully. There are 2 calculations that we are supposed to make. One more important information that the question has given us: the company has not yet opted for the concessional tax regime. They have not yet opted any kind of concessional tax regime. Now, the only option which they have right now is 115BAA, because 115BA is not possible. BA is possible if you opt in the first year. BAB is also not possible. BAB is also possible only if you opt in the first year of the operations. But BAA is open for every year. Okay. So therefore, we need to make 3 calculations here. Let me tell you how 3 calculations. First, normal calculation. In normal, there will be 2 calculations. One regular provision and one MAT, because they have also given us book profit over here. The book profit of the company is given over here as 520 lakhs. So under the normal provision, you will make 2 calculation, one regular provision and one MAT calculation. And under the 115BAA, only 115BAA, because an assessee opting for 115BAA is not liable for MAT. So accordingly, we need to solve this question 3 times. Okay. So let us first of all solve this question as per the normal provision. Okay. Now there are 4 businesses over here. The first business is the chemical manufacturing business. The assessee is engaged in chemical manufacturing unit, and the profit of the assessee is 300 lakhs. Now they have paid some royalty to someone. Okay. They have paid some royalty to someone, and on the royalty of 10 lakh rupees, they have not deducted the TDS. They have not deducted TDS on 10 lakh rupees. Okay. Now, if they have not deducted TDS on 10 lakh, this 10 lakh rupees will be disallowed to the extent of 30%. Okay. But there is one information which is given in the question, that the other party, that is the payee has included such royalty in his income. Payee has paid the tax. Payee has also filed the return before the due date of filing of return. So will this royalty still be disallowed? The answer is yes. Even if the payee has included the income, paid the tax, and the return is also filed, still the royalty will be disallowed in the current year, and next year it will be allowed to me. It doesn't matter whether the payer has included or not. Even if the payer has included, in the current year it has to be disallowed. In the subsequent year, it will not be disallowed. It will be allowed in the next year. So therefore, what is the treatment of this 10 lakhs? 30% of this will be allowed in the disallowed in the current year, and it will be allowed in the next year. Next is, you are making some contribution to notified pension scheme of employee. How much is allowed? It is only allowed if an employer contributes to the notified pension scheme of the employees. It is only allowed to the extent of 10% of the basic salary plus DA in terms. Company is contributing 15% of basic and DA in terms. Therefore, how much will be disallowed? 5% will be disallowed over here. So 33,60,000 is 15%. Therefore, 5% is how much? 11,20,000. You have to disallow that. This is the profit of the first business. Okay. Now, second business, furniture manufacturing business. The assessee has a net profit of 90 lakh rupees. An assessee has bought one trademark of 25 lakh rupees. This is a very traditional adjustment. Now, and they have debited that trademark as an expenditure. Wrong. You cannot debit a trademark as an expenditure. You have to add back 25 lakhs and you have to claim 25% intangible asset depreciation. Okay. Next, the company has paid rupees 3 lakh as interest to non-resident, and the TDS is deducted on time, and it is also paid on time. See, it is deducted in the month of March, and it is paid before the due date of filing of return. Therefore, this expenditure of 3 lakhs will be allowed to the assessee. So no effect will be given to this expenditure. Okay. Next one, company paid rupees 7 lakh as tax on non-monetary perquisites of the employee. Do you remember that? If an employer pays the tax on non-monetary perquisites of the employee, then that tax is disallowed under the income tax law under section 40 clauses sub clause 5. So I'm an employer, you're an employee, I am paying your tax on non-monetary perquisite, it is disallowed. Therefore, this 7 lakh will be disallowed under the income tax law. Next, coming to the fertilizer producing unit. Fertilizer producing unit will be eligible for what? Will be eligible for 35 AD. Because if an assessee is engaged in production of fertilizer, it is eligible for deduction under section 35 AD. Now, in 35 AD, assessee has purchased land of 1 crore. Land will not be allowed. Building of 2.5 crore. Yes, building will be allowed. And 3 crore rupees will be machinery. That will also be allowed as a deduction. Okay. But what will be the profit? The profit is 220 lakhs. and the company has computed the profit after debiting the depreciation. Therefore, in 3580, you don't get the deduction of depreciation. So how will you compute the income? 220 lakhs is the profit after depreciation. Therefore, add back both the depreciation and then take the deduction of land, of building, sorry, not of land, and of plant and machinery. You will get the profit under 3580. Okay. Next one, last but not least, warehousing facility of edible oil. Now it is a normal business. In this business, there is a loss, I guess, because there is a net profit of what? Net profit of 7 lakhs. And on building, you will claim 10% depreciation, and on plant and machinery, you will claim 15% depreciation. So there is a loss. This loss can be set off against the other business income. Okay. Apart from that, the company has also received some application money from the shareholder, and that is deposited in the bank, and they have earned some interest on that particular money. So whenever you receive some share application money, you deposit that in the bank, and on that, if you earn interest, that is not considered to be an IFRS income. That should be set off against the share issue expense. Therefore, this amount should be set off against what? Against the share issue expense. Apart from that, the company has received a dividend of 56 lakh rupees. This will go to IFRS, but the company has also given dividend of 40 lakh rupees. Therefore, for that purpose, the company will claim deduction under ATM. Okay. So we have received 56 lakhs and we have given 40 lakhs as distributed 40 lakhs as a dividend to our shareholder. Therefore, 40 lakhs will be allowed as what? A deduction under ATM. Okay. And last but not least, then we will compute the profit tax of the assessee. The turnover of the assessee for last to last year is 390 lakhs, and because the turnover of last to last year is 390 lakhs, therefore tax will be only 25% plus surcharge if applicable, and cess will be applied. This will be our first calculation in the normal provision. Then we will compute the second calculation in the normal provision, that is book profit, that is MAT. 520 lakhs is my book profit, and directly they have given the book profit, computed book profit. On that 15% MAT will apply, 7% surcharge because the book profit is more than 1 crore, 4% cess. Then whichever is higher will be your calculation number 1. Now I am coming to calculation number 2. What is calculation number 2? Calculation number 2 is 115BAA, because they have told us to compute the optimum income tax liability. So we will compute 115BAA. Now in 115BAA, what will happen? In 115BAA, first of all, you will not be getting the deduction of what? 3580. 3580 will be disallowed over here. So I will disallow 3580. Whatever 3580 deduction I have taken, that I have to disallow. But in 3580, I will claim the depreciation. Because in 3580, I will get the depreciation deduction, but I will not get the normal provision deduction. Okay. So this I will add back, and this I will take the deduction. Okay. Apart from that, there is no other thing. ATM is allowed under ATM is allowed under 115BAA. Apart from this, there is no other calculation. I will just compute the tax as 22% tax, 10% surcharge, and 4% cess. That's it. This will give me my tax liability. I hope it is clear to all of you. Then I will compare whichever is more beneficial, that I will opt as a taxpayer. Okay. Now let's move on to the next question. The next question is also a very new kind of question. We have not done this type of question in the earlier papers. Okay. So ABC Private Limited is there. Now that is converted into an LLP. So remember, whenever a private limited or an unlisted company is converted into an LLP, the provisions of section 4713B is applicable. Now when they have converted on 1st of October 2023. Now there are a lot of questions that we need to answer. Whether the loss can be carried forward or not. Whether the loss can be carried forward from the company to the LLP, the answer is yes. Only a non-speculative business loss and unabsorbed depreciation can be carried forward. A non-speculative business loss can be carried forward for another years, and unabsorbed depreciation can also be carried forward for infinite number of years. But the LLP has to fulfill the conditions. Whatever 7 conditions are given in 4713B, the LLP has to fulfill that. Later on, if LLP violates any of the conditions, then whatever loss is set off, that will be considered to be deemed income. So all these loss carry forward is subject to the conditions mentioned in 4713B. Okay. Second, the company has some assets, that is plant and machinery of 15%. The WDV is 14 lakhs. The plant and machinery of 75 lakhs, on which 3580 deduction is claimed. So whatever asset on which 3580 is claimed, that cannot be, that the actual cost of that asset is nil. Therefore, this will consider to be nil for the LLP also. So if the company has claimed deduction on under section 3580 on any asset, then LLP also cannot claim depreciation on that asset. So forget about the second asset. First and the third asset, we can claim depreciation. Both of them will claim depreciation on a proportionate basis on the basis of number of days. Okay. So 14 lakhs, 40 lakhs, 14 lakhs, depreciation 15%, 2,10,000 LLP and the company. Both of them will take the deduction based on number of days the assets are used by both of them. And whatever is the depreciation which is claimed by the company, that is predecessor, that will be reduced from the cost of the, that will be reduced from the WDV of the asset, and the balance WDV will be WDV of the LLP. Okay. For example, here the WDV of building is 14 lakhs and total depreciation is 2,10,000. Now 1,05,000 is claimed by LLP, 1,05,000 is claimed by company. Therefore, whatever is claimed by company, that will be reduced and the balancing figure will be WDV for the company. Okay, for the LLP. So this is how you are going to compute the depreciation and the WDV of the asset. Next, what will be the cost of acquisition for the land in the hands of the LLP? The cost will be the cost to the previous owner. So whatever is the price at which the previous owner has acquired, for 80 lakhs, that will be the same as cost. Market values are of no relevance. So everywhere, wherever market value is relevant, just strike it off. It is of no relevance under section 4713B. Next, VRS, How VRS is allowed? Generally, VRS expenditure is allowed under Section 35 DDA in 5 equal installments. So, in the year of conversion, who will get the deduction? In the year of conversion, the new entity will get, that is the LLP will get the deduction, and for the future years also, LLP will get the deduction. So, accordingly, we are going to take the deduction of this particular 28 lakh rupees. Next, MAT credit will not be carried forward. It is very clearly written in 4713B that MAT credit cannot be transferred to the LLP. It will be lapsed. Okay, and annals of depreciation will be transferred, as I have told you earlier. Now, the next question is a very simple question on DTAA. I am not interested much on that. Mr. Money is there, 71 years age is there, etc., etc., etc. It's a very traditional question, nothing great as such. So, I am not wasting much time on this particular question at least. Yeah. The only thing you need to understand over here in DTAA questions from May 2024, you need to be very careful with the regime that you are following. If nothing is mentioned, you will follow old, you will follow new regime. If they are specifically saying that you have to opt out of the new regime, then you will follow the old regime. Okay, you have to be very careful with this particular aspect in the examination. Now, coming to the next question. Next question is on charitable trust and electoral trust. So let's see the first question. What is the first question trying to say? There is a person called as, there is a trust called as Satvik who has sold one of the building. One of the building is sold for 4.2 lakhs. This is the consideration. This building was purchased in 2022 for 2.2 lakhs. So it is sold within 24 months. So if a building is sold within 24 months, 4.2 lakhs minus 2.2 lakhs, 2 lakhs will be STCG. Now for trust, there is an exemption under section 11(1)(a) to save capital gains. So what is the exemption? The exemption says that whatever is the net consideration that you have to invest in the new asset. Okay. So whatever is the net consideration, how much is the net consideration? The net consideration is 4.2 lakhs. So if you invest that in the new asset, your entire capital gains will be exempt. But if you don't invest the entire amount in the new asset, then only a proportionate capital gains will be exempt. So Assassi has sold the asset for how much? Assassi has sold the asset for 4.2 lakhs. Then he should have invested 4.2 lakhs in the new asset, but he has not invested 4.2 lakhs. He has only invested 3 lakh rupees in the new asset. Then only proportionate exemption will be allowed. What is the proportionate exemption? Cost of new asset minus cost of old asset. What is the cost of new asset? It's 3 lakh. What is the cost of old asset? It is 2.2 lakh. Therefore, the differential between two will be allowed as deduction. What is the differential between the two? The differential between the two, 3 lakhs minus 2.2 lakhs, 80 lakhs. And therefore, the 80,000 will be allowed as exemption and 1.2 lakhs will be taxable in the hands of the what? In the hands of the Satvik Public Charitable Trust. Okay. I hope it is clear to all of you. Next one is a very simple question that there is a religious as well as a charitable trust which is running a temple as well as a school. Now, it received an anonymous donation. Now, 3 crore is received for temple and 8 crore is received for school. Remember, if anonymous donation is received for religious purpose, section 115 BBC is not applicable. Do you remember that or not? But if the anonymous donation is received for what purpose? If it is received for what purpose? If it is received for charitable purpose, then provision of 115 BBC is applicable. So in this case, the provision of 115 BBC is not applicable for temple donation, but 115 BBC is applicable for school donation. I hope it is clear to all of you. Now, the next question is a very, very important question on electoral trust. Now, such kind of question they have never ever asked in examination, electoral trust and all. Now, why they have suddenly got reminded of this question? Because of the election. Because there is a union election 2024, there are chances that there might be question on electoral trust or electoral bonds in the examination. So you have to be very careful with these kind of questions in the examination. You read the provisions thoroughly over here. Okay. Now, there is an electoral trust over here, which is incorporated in 2022. That is last year they have incorporated. So this is the second year of the electoral trust. So this is a very important data for us that this is the second year of the electoral trust. Okay. Now, this electoral trust has received a voluntary contribution of 420 lakhs in the current year. And there is a surplus brought forward from the earlier years. Means whatever donation they have received in the last year, out of that they would have given a lot of money as a contribution, as a donation to political party. So the surplus left is brought in the current year. Okay. Now, they have also incurred some expenses to manage the affairs of their entity, which is 8 lakh rupees. Now, they are asking us question, what is the amount of surplus that can be distributed by the electoral trust, assuming that all other conditions are provided under the Income Tax Act are satisfied? Now, listen carefully. There is a very important catch over here. Listen carefully. How much money electoral trust can distribute? Listen, electoral trust can distribute if it wants to enjoy exemption under section 13B, it has to distribute at least 95% of the total contribution, including surplus of last year. So they have to distribute at least 95% of 420 plus 18 lakhs. That is, they have to distribute at least 95% of 438 lakhs. Then only they will enjoy exemption. But how much they are allowed to distribute, that is altogether a different case. For that also there is a separate provision. That is a separate provision which I am going to tell you now. Listen carefully. If this is the first year of the electoral trust, they can only how much they are allowed to use for the managing the affairs of the business. Okay, so they have to manage the affairs of the electoral trust, right? Because they have to check who has given the donation, they have to keep the record of that, they have to check when to pay the payment to the which political party, whether it is credited or not. So all this is a matter of management. So listen carefully. I am again saying it's a very critical point. It can come in the examination. Again saying the first point, whatever donation they have received, including the surplus of last year, of that 90% should be distributed. Okay, but you need to also see only that how much is allowed to use as a managing as an affairs of the electoral trust. They have used how much? They have used 8 lakh rupees. Are they allowed to use 8 lakhs? For that also there is a provision. There is a separate rule for that which is made by central government. So how much they can use, sir? In the first year, they can use 5% of the total, 5% of the donation. That is 5% of whatever donation you have received. Compare with 5 lakh rupees, not more than 5 lakhs. And in the second year, because this is the second year for us, this is more relevant. In the second year, they can use only 5% subject to 3 lakh rupees. Okay. So in the second year, they can use only 5% of 420 lakhs subject to 3 lakhs. So 5% of 420 lakhs comes to 21 lakh rupees. Compare with 3 lakh rupees. Therefore, whichever is lower will be allowed to be used to manage the affairs of the electoral trust. They are using 8 lakh rupees, not allowed. Okay. So out of 438 lakhs, they are allowed to use only how much? They are allowed to use 435 lakhs. 435 lakhs. They can use on 3 lakhs they can use for the purpose of managing the affairs. 435 lakhs is the distributable surplus. So they have asked that only. How much is the distributable surplus? So you have to reduce whatever is the eligible amount to be used for managing the affairs. After that, whatever is left, that will become your distributable surplus. Okay. Now that distributable surplus has to be more than 95% of your total donation. Is it more than 95% of your total donation? Yes. So out of the distributable surplus, you can distribute 416.1 rupees and you will claim 100% exemption in the current year. Okay. So this is how you are going to compute the electoral trust ka exemption and distributable amount. I hope it is clear to all of you. Now let's move on to the next question. Next question is a very simple question on your transfer pricing. There is one assessee, there is another assessee, and one entity gives a guarantee of 12% of the total loans of another entity. Therefore, both of them are what? Deemed to be associate enterprise. If one entity guarantees 10% of the loan of the another entity, then both of them are deemed to be associate enterprise. Okay. Now, suppose they are deemed to be associate enterprise, that we have answered. Now, the question says that suppose the AO makes a primary adjustment of 310 lakhs. Who is making the primary adjustment? The AO is making a primary adjustment of 310 lakhs on 31st March 2023, and the same is also accepted by the assessee. Now, what are the requirements as per the income tax law and the non-implication with the assessee has to fulfill? Okay. So, for example, if the AO makes a addition as per the primary adjustment on 31st of March, what are the requirements that the assessee has to fulfill? Assessee has to bring back that money into India within 90 days on the date of order. If the assessee does not bring back that money within 90 days on the date of the order, then the assessee will be considered to be having given a deemed loan to the associate enterprise, and the assessee will be liable for secondary adjustment. Secondary adjustment is nothing but interest on the deemed loan. So whatever is the amount, 310 lakhs, on that assessee will be liable to pay interest. Okay. Interest will be computed as what? Because the transaction is denominated in Indian rupees, interest will be computed as per SBI MCLR plus 3.25%. Whatever is the SBI MCLR plus 3.25% will be considered to be the interest rate, and interest will be computed from 31st March only. From 31st March only interest will be computed. Is there any other way that the assessee can get evade from that? Yes, one more option is there. The assessee can pay one-time additional tax of 18% tax, 12% surcharge, 4% cess, and then the assessee will be relieved from this particular kind of secondary adjustment. Okay. So these are the two options. Right now, there are three options. First is you have to bring back the money within 90 days. Nothing will happen. If you don't bring back the money, pay interest. Or if you pay the additional tax, then the interest is not liable to pay it after that. Okay. So these are the three possibilities which are there. Now, the next question is exactly same as question number 6 of Series 2 MTP November 2022. That's the reason I'm not much interested in that. It is on section 269 SU and 271 DB, not very great question. Okay. Next question is again a new question. It's a very good MTP. There are a lot of good questions in this particular paper. The tax assessment was completed on 25th of December. The tax assessment of completed on 25th December of Mr. Raghav, and the department has raised a demand of 28 lakhs. Now, assessee has the following things. Now, the question which is asked over here, the department can recover the money from which all things? The bank deposited which belongs to assessee, definitely the department can recover from there. The receivables from the debtors, the department can ask the debtors to pay the money. Okay, garnish order. Do you remember that? The department can go to and tell to the debtor that give the money to us and not to the assessee. Third, the assessee has gifted land to his major son. Now, whatever is gifted to his major son, that is not clubbed in the hands of the assessee. Whatever is gifted to the major son, that belongs to the major son. Now, department cannot go to the major son and recover the money from the land. Okay. Now, a diamond necklace given to his son's wife. So, a diamond necklace given to son's wife is clubbed in the hands of father-in-law. Remember or not? If I give something to my son's wife, that is clubbed in my hands. If I give it without consideration, therefore that is clubbed in my hands. Therefore, the department can recover from there. Okay. Plus, I also have an apartment in Australia. That is my apartment. The department can recover from there only. Rule is very simple. Whatever belongs to me, the department can recover. Whatever does not belong to me, but the income can be clubbed in my hands, that can also be recovered by the department. Okay, this is what this question is all about. Now the next question is on Vodafone case law and its effects. There is an Indian company, XYZ Indian company. This company is engaged in manufacturing and packing material, and it has a wholly owned subsidiary of Flix Inc. XYZ company is a wholly owned subsidiary of Flix Inc. So listen carefully. There's a Flix Inc. which is in country M, which is a foreign company. Indian company is a 100% subsidiary of Flix Inc. Now Flix Inc. has two shareholders. Angelo holds 50% and James holds 50% in Flix Inc. Okay. Now, so after some time, Flix Inc. is selling the shares. Angelo and James are selling the shares of Flix Inc. Now, when Angelo and it's just like Vodafone case law. Flix Inc. CGP, Angelo and James are what? HTIL, and Indian company is HEL. Okay. Now, Angelo and James, whenever they are selling the shares, whether they will be liable for capital gains or not, for that purpose, they have given us all the data. The capital gains will be chargeable in the hands of Angelo and James if the shares of Flix Inc. derive its value substantially from asset located in India. For that purpose, we need to do a long-term exercise. What exercise? First of all, let's see when the shares are sold. The shares are sold on 1st of June 2023. So 1st June 2023 is the date of transfer. Then we need to see what is the last balance sheet date. The last balance sheet date of the company is 31st December 2022. So 31st December 2022 is the last balance sheet, and 1st June 2023 is the date of transfer. Now, we need to see the shares of Flix Inc. should derive its value substantially from asset located in India. What do I mean by derive its value substantially from asset located in India? Two conditions have to be fulfilled. The assets which are located in India has to be at least 10 crore rupees, and the assets which are located in India has to be at least 50% of the total assets. Okay, these two conditions have to be fulfilled. Now, these two conditions should be checked on which date? These two conditions should be checked on a specified date. So for that purpose, we need to find out first of all what is the specified date. The specified date can be two dates. The specified dates can be last balance sheet date. The specified date can also be the date of transfer. By default, it has to be last balance sheet date. But if the difference in the book value of the asset is more than 15%, then the specified date will be 1st June. If the difference is less than 50%, then the specified date will be last balance sheet date. So while checking the specified date, you have to check the book value of the assets. Okay. So book value of the assets. What is the book value of the assets on 31st December? On 31st December, that is last balance sheet date, book value of asset is 1000. What is the book value of assets on date of transfer? It is 1300. Is the difference between the two more than 15%? The answer is yes. Therefore, the specified date will be the date of transfer. The specified date will not be 31st December. If the difference would have been less than 15%, then the specified date would have been date of balance sheet. So now the specified date is 31st June. Okay. Now on this date, we are going to check the value, whether the Indian assets. Now while checking the value, the Indian assets, you have to check the fair market value of the assets without reduction of liabilities. Now how much assets are there in India? The Indian assets are 600 crores. Check. The fair market value of the assets in the balance sheet of XYZ is how much? Is 600 crore. Now, what is the fair market value of the total assets? It is 1100 crore. Okay. So therefore, the fair market value of the Indian assets is how much? It is 600 crore, out of which the total assets is 1100 crore. Therefore, 600 divided by 1100, Indian assets are more than 50%. Therefore, both the conditions are fulfilled. Because both the conditions are fulfilled, Indian assets are more than 10 crore and Indian assets are more than 50% of the total assets. Therefore, the shares of Flix Inc. derive its value substantially from asset located in India, and therefore, whenever James and Angelo and James will sell the shares, they will be liable for capital gains in India. So this is how we have done a similar question in the class. We have done all those kind of questions in the regular batch, fast track batch. It is there in our color book also, in our regular batch book also, everywhere. All this kind of questions are already there. Okay. Now, there are some case laws over here, but all the case laws we have already done either in RTP, MTP or past paper, 100%. I have written the names also. Pepsi Food Limited, we have already done. Lakshman Das Khandela also, the third one is also done. You can check it once if you want. So don't waste time on repeating the same questions again and again. Next is the theory question. Discuss the three-tier structure of BEPS action plan. So you need to answer that. The three-tier structures are master file, local file and CBCR, and then you have to write few lines in each and every category. Okay. Next question also we have already done. You can check this. We have already done this question. Question number 6. Check please. Done earlier. Same question we have already done. Check it please. Now the next question is a very beautiful question on tax audit report. This kind of question you would have not find in earlier paper, because in earlier paper tax audit was not there in direct tax, it was there in audit. So for the very first time, tax audit report question is there. We have done this question also in our class. You can go and check. Okay. There is a firm which is employed, which is in retail business, employed 30 new employees on 1st April 2022 with a monthly emolument, monthly salary of 24,500, which is paid by account paycheck. Okay. So they have paid by account paycheck. In addition, each employee was entitled to 10% employer contribution to the recognized provident fund, and the employee was also paid 3,500 in cash. Okay. The gross total income of the assessee includes profit of 75 lakh rupees. So what is the data? The salary is 24,500 paid by account paycheck. And in addition, the employer is also contributing 10% to the PF, and the employer is also paying 3,500 rupees transport allowance in cash. Okay. Now, The firm has claimed the deduction of 30 employees into 24,500 into 12 as the deduction under 80 JJAA. The CA has also given a report under Form 10DA, and the chartered accountant contend that the emoluments do not include employer contribution, and also cash payment were not to be considered as additional employee cost. The CA said that emolument does not include the PF part, and emolument does not include cash component also of what? Of the cash component of what? Which is paid in the form of a transport allowance. Okay. Now, hence 24,500 per employee is the emolument, therefore the deduction will be given. Is this contention correct? Explain the ethical implication. Now remember, as far as 80 JJAA is considered, 80 JJAA says that the emolument of the employee should not be more than 25,000 rupees per month. Now, emolument will include everything. Everything will be included in emolument except few things. That is contribution made by employer to employee and certain long-term benefits like severance pay, retrenchment compensation, etc., etc., etc. But emolument will include transport allowance. Even if it is paid in cash, it will be included. So if we consider that, by that logic, it will come to 24,500 plus transport allowance 3,500. It will, emolument is actually 28,000, which is more than 25,000 rupees. Therefore, the chartered accountant is wrong. A chartered accountant should not have made such comment. Okay. Therefore, he should have reported this in clause 33 of Form 3CD, and if he does not report that, then he is liable for what? Guilty. He is guilty under clause 7 of part 1 of second schedule of Chartered Accountant Act 1949, which you would have done in your audit paper. I hope it is clear to all of you. Now, while taking the emolument, the Chartered Accountant has not taken the cash transport allowance. He should take that also. The total emolument paid to the employee will include all kind of payment made to the employee except the contribution which is made in the form of recognized provident fund. Okay, so this is what this question is all about. One last question we have done earlier. There is an advance ruling who has passed an order and you are not happy with the order of the advance ruling, and so is it binding on you? The answer is no. Advance ruling is never binding on assessee. The board for advance ruling, you can appeal to High Court. We have done earlier within 60 days. We can also get an extension of another 30 days if there is a genuine reason. Okay, so this is what this beautiful paper is all about. I hope it is clear to all of you. So let's want one to one last MTP, that is the 8th MTP in the series of our discussion and 23rd paper in the series of our discussion. MTP May 2024 series 2, but fortunately for us in this MTP there is very less thing to speak on my behalf, because 90% of the things in this MTP are repeated. 90%, I am not saying 90%. ICI does not have any time also to make a separate MTP for you all. They have just copy pasted the things from the last paper and they have put over here. I hope that in the exam also they do the same thing. They copy paste 90% of the things from our 23 MTPs, RTPs and exam paper and put in the exam. That will benefit us to a great extent, because I don't think so anybody has done this exercise in the entire country. Forget about in English, even in Hindi, nobody has done this entire exercise of compiling 23 papers, so many RTPs, so many MTPs and so many exam papers in a span of 7 to 8 hours, maximum 7 hours. So this is what we have tried to achieve over here. I hope we have been able to achieve it. You guys comment below and let me know, are we able to achieve our target properly or not? Are we able to optimize the resources properly or not? Are we able to optimize our time properly or not? So that in a very small span of time, we are trying to cover many concepts. Highly impossible for ICI now to go beyond this and make a paper. Okay, ICI has to stick to our 23 compilations and make the paper. There is no other option available with the ICI. So let us start with the first question. The first question is a different question, not completely different. To some extent it is different, but rest of the questions, most of them are repeating from the past papers or MTP or RTP. The very first question, there's a domestic company. The domestic company is incorporated. It is engaged in manufacturing and it is incorporated in 2023. And now again in this question, just like the previous question, they have told us to compute the total income, the tax liability in a most beneficial manner. So again, we are supposed to compute multiple calculation, 3 calculation last the last paper. First, normal calculation, in normal 2 calculation, regular and MAT, because they have also given us book profit. Then the special provision. Which special provision will apply over here? A domestic company which is newly incorporated, it is manufacturing 2023, therefore we can follow 115 BAB. 115 BAB can be followed over here. 115 BAB, all the conditions are fulfilled over here. Okay. Now let us solve the sum first of all as per the normal provision. As per the normal provision, the profit is 1 crore 47 lakh. Depreciation will be added back. Then you are buying some intangible assets of 36 lakhs. You add back this, and on that you will claim 25% depreciation, but you will get only 50% because it is put to use for less than 180 days. Therefore you will get only 50% of your 25%. Okay. Next one, you have purchased some gold raw material from your directors, and directors have substantial interest. Therefore directors are related party. Therefore, the excess payment which you have made, 12 lakh rupees or 14 lakh rupees excess, that will be disallowed under the income tax law. The next adjustment is a new adjustment. You have received some subsidy from the state government for buying a new plant and machinery. Now remember, whenever you receive any subsidy from the government or from any person, subsidy, grant, reimbursement for buying an asset, that has to be reduced from the cost of asset. So first of all, reduce from PGBP and then reduce from plant and machinery also. The plant and machinery is mentioned over here. It is purchased for 75 lakhs. So you have to reduce this 15 lakh rupees from here. Okay. I hope it is clear to all of you. Then you have incurred some legal expenses for issue of bonus shares. So whatever expense you incurred for bonus shares, that is allowed under income tax law. Remember, we have done 9 case laws based on this, and whatever expense you incurred for right shares, that is not allowed under the income tax law. Okay. Next one, short-term capital gains on which STT is paid. Therefore, it is covered under 111A. Therefore, reduce from here and show under 111A. You will show under 111A. Okay. 111A capital gains 15% tax. Depreciation under income tax law 36 lakhs. You can claim that as a deduction. Okay. Then you are selling some shares of unlisted company within 24 months. If you are selling within 24 months, then it is short term. Therefore, you have bought for 22 lakhs. You are selling for 12. You have bought for 12 lakhs. You are selling for 22 lakhs. Therefore, 10 lakh will be capital gains. This will be chargeable at 20%. Okay. Short-term capital gains are chargeable at normal rates. Okay. Now, last but not least, here you are purchasing some plant and machinery of 75 lakhs. But out of that, unfortunately, 10 lakh is paid by bearer check. Not allowed. Therefore, if you purchase any asset and if you make the payment of more than 10,000 rupees by other than account pay check, account pay draft, ECS and such as electronic mode, then it is not going to be forming part of your actual cost. Therefore, from 75 lakhs, first of all, reduce 10 lakhs and then 15 lakhs your what? Your subsidy which is received from the government. Therefore, your actual cost is 50 lakhs. On this 50 lakhs, you compute what? Because machinery is acquired and assume that put to use on 1st of July. On this machinery, depreciation is not included above. In point number A, depreciation is not included for this machinery. Therefore, claim normal depreciation 15% and additional depreciation 20%. After doing that, compute the tax liability, and after computing the tax liability, the tax liability will be 25%. Why, sir? Because this is a new company, and if it is a new company, the turnover of last to last year is 0. If the turnover of last to last year is 0, it is less than 400 crore. Therefore, 25% tax rate, surcharge and cess if applicable. Okay. Now you will compute the book profit. Book profit 320 lakhs. On that, you will apply 15% MAT. 7% surcharge because the profit is more than 1 crore and 4% cess. Okay. Then you will compute 115 BAB. Sorry. In 115 BAB, there is going to be only one change. What is that one change? You will add the additional depreciation. Apart from that, nothing else will be added back. So additional depreciation should be added back. After that, you will get the profit as per the 115 BAB. And in 115 BAB, your normal tax rates will be 15%. STCG under 111A will also be 15%. But normal STCG will be 22%. Okay. The normal STCG means what? The STCG on this equity shares will be chargeable at 22% under 115 BAB. Then you will apply 10% surcharge and 4% cess. This will give you the computation of your tax. Then you compare which is more beneficial. The normal provision is beneficial or 115 BAB is more beneficial. Then accordingly, you opt that. Okay. Now, the second question, as I've told you, 90% of the paper is repeated from past paper and past exam and past MTP, RTP or exam paper. This is exactly similar question, MTP Series 2, November 2023. We have done this question, copy paste question, copy. You can check it once if you want. The next question is also copy paste. I'm not interested. Almost all the questions are here copy paste now. This question is copy paste. This question is copy paste. We have done all these questions. This question is copy paste. You have done all this question. This question is copy paste. This question is copy paste. All these questions are already done with all of you. Okay, you can go and check it once if you want. Okay, all the questions are done. You can, I'm not just saying in the air just for the sake of saying. I have done so many papers. What it will take for me to do another one paper completely. But if something is repeating, it doesn't make sense to do it again and again. You also should not do on the day of examination. We don't have so much time to do repetitive things again and again. This question is also repeated. This question is also repeated. Check it once if you want. Okay. Now the next question is a case law. There are some case laws over here. All of them are new case laws. We have not done this case laws in the past papers. Definitely we have done all these case laws in the classroom. In our textbook it is there, but we have not done in the past paper compilations. Okay. Now the first question is there is an income tax appellate tribunal decided the case against the SSC. So ITAT has passed an order against the SSC. Therefore the SSC filed an appeal to the High Court. Okay. The SSC filed an appeal to the High Court for framing substantial question of law. Because we all know that if you want to go to High Court, there has to be a substantial question of law, a substantial question of fact cannot go to the High Court. Therefore, if you want to go to High Court, you need to have a substantial question of law. So the SSC filed an appeal framing substantial question of law. But the High Court did not frame the substantial question of law. The High Court heard both the party and then passed the order, okay, without formulating any substantial question of law. Is High Court also supposed to formulate a substantial question of law? The answer is yes. The SSC will frame substantial question of law under section 260A subsection 2, and the High Court will frame substantial question of law under section 260A subsection 3. Therefore, High Court cannot just rely on the substantial question of law which is framed by the SSC. The High Court has to frame its own substantial question of law. there is a difference between the formulation made by the SSC and the formulation made by the High Court. Therefore, the Supreme Court held in the case of AA Estate Private Limited that the order of the High Court is void ab initio. It is incorrect. Okay, the High Court has to pass a substantial question of law, has to formulate substantial question of law. It cannot merely rely on the substantial question of law formulated by the SSC. Okay, the next question is a cooperative society. It is engaged in marketing of fertilizer and purchase and processing of seeds grown by its members. Okay, therefore it is eligible for deduction under ATP. Now the AO disallowed some expenditure under 14A. Now the question is whether 14A is applicable for chapter 6A. 14A is not applicable for chapter 6A. We have done this case law of CIT versus Scribho, Delhi High Court 2012 judgment in our classroom also. That 14A is applicable when an expense is incurred to earn an income which is exempt under section 10. 14A is not applicable for an expense which is incurred for an income which is deductible under chapter 6A. 14A is not applicable for profit link deduction which is deductible under chapter 6A. It is only applicable to an income which is exempt under section 10. Therefore, in this case, 14A will not be applicable. Okay. Next one, Mr. Sudarshan is a shareholder in a particular company. Now he received a bonus shares from the company which is more than 50,000 rupees. Whether the bonus shares which is received from the company which is more than 50,000 rupees, Dr. Ranjan Pai case law it is, whether it will be chargeable as income from other source as a gift tax. Suppose I am a shareholder in a company and company is giving me some bonus shares. Now whatever bonus shares the company is giving me, whether that will be considered as a gift under section 56 to 10? The answer is no. Bonus shares is not. The Supreme Court has held that in the case of Dr. Ranjan Pai that bonus shares received is not a gift. It is not a gift. Bonus shares is not for free. It is not received for a free. It is received at a cost of capitalization of the reserves. Your reserves in the company is getting capitalized in the form of bonus shares and that is given to the shareholder. It is not an absolutely free consideration received to you. Okay. Therefore, this is not going to be charged under section 56 to 10. Next one, they are asking us some theory question. Just go through it. Some digital economy, etc. What are the e-commerce and what is the action plan 1 of BEPS? I'm not interested in that. The next question also we have already done. This question we have already done. This question also we have already done. You can check both of them. I'll tell you what is there in these two questions. This question talks about that in 2016 if you have done something, GAR is not applicable. Remember, GAR is applicable in one of the MTP question. I have made you change the date also from 2018 to 2016. So if GAR is only applicable if the transaction is undertaken on or after 1st April 2017. So GAR is not applicable in this case. Second question, very simple. This company can directly give loan to this company, but they are deliberately purchasing some equity in a tax haven company. First, they are transferring the money to tax haven and then telling the tax haven company to give a loan to this company. Therefore, the GAR will applicable in this case because the country X company C lacks commercial substance. There is a round tripping of fund. Okay. The main purpose of this transaction is to obtain tax benefit, and if the tax benefit is more than 3 crore, GAR will apply in your case. Okay. I hope it is clear to all of you. Now, the next question is a beautiful question. This is the only question because of which we are doing this particular paper. Otherwise, there make no sense to do this paper. Okay. This is the only reason. This is again a question of tax audit. Now, I can make out one thing that the two mock test paper which has come for May 2024, in both the mock test paper, ICI has given one question on tax audit report. So they can make out from this that there can be one question in the exam on tax audit report. In both the paper, they have not asked any question on black money law. Maybe they might have asked question on black money law in the MCQ, but on descriptive question, they have not asked any black money law question. Okay. Now, this is a beautiful question. Income tax department collected some documents from a bank which revealed that a travel company, Mrs. Esther and Travel Company, has remitted substantial amount abroad. Okay. So income tax department got an information from the bank that that particular travel company has remitted huge amount outside India. Okay. For that, the income tax department collected form 15 CB also issued by the chartered accountant, and chartered accountant list of passengers were collected, copy of their passport were collected, travel and invoice were collected on inquiry, and then the income tax department went to the passengers. The income tax department went to the passengers to verify that whether they have actually traveled or not. The passengers say that they did not travel, and the dates mentioned in the documents. The passengers said that we have not traveled. All these documents are fake. Okay. And the chartered accountant also given form 15 CV which is fake. The passenger denied any sort of transaction. The department therefore concluded that the amount remitted on the basis of false invoice. The department therefore said that all this money which is remitted outside India is based on false invoice. Okay. Therefore, there is a FEMA violation, and 15 CB issued by the chartered accountant is also wrong. Okay. Therefore, the chartered accountant has in all issued in a period of 9 months 105 certificates from 15 CB, 22 crore worth of transaction. For every transaction, for every certificate, he has charged 3,500, mostly in cash. Okay. The form 15 CB submitted that, the chartered accountant submitted that he has issued form 15 CB based on invoices produced by the company. CA said that whatever invoice the company gave me, I submitted based on that form 15 CB, verifying the KYC documents of the signatory. However, he failed to bring on record the invoices. When the department asked for the invoices from the chartered accountant was not able to give the invoices. He further submitted that since he has not been been statutory auditor, he did not examine the books of account. The chartered accountant said that I have just given the certificate form 15CB. I am not a statutory auditor of the company. Therefore, I did not examine the books of account or conduct due diligence. Can a chartered accountant do like this? And therefore, this is absolutely wrong. 15CB certifies that he has examined the transaction properly. The very object of 15CB is defeated over here. The 15CB is given by a chartered accountant only if he is 100% sure that he has done everything. A chartered accountant should verify the agreement, should verify the document, should verify the books of account, should verify the TDS requirement, whether TDS is properly deducted or not, should verify the nature of remittance. But CA only verified KYC of invoices. Therefore, he is guilty under the Chartered Accountant Act, Clause 7, Clause 8, Part 1, Schedule 2, failure for due diligence. Therefore, action will be taken against him under the CA Act 1949. I hope it is clear to all of you. We have done a similar question in the class also. This question is there in our question bank also. Okay, you can go and check. One last question over here. A partnership firm is there and they have given the date of the partnership firm. We need to answer whether this partnership firm is required to get the books of accounts audited or not. Now you please tell me who is required to get the books of accounts audited if your turnover of business is more than 1 crore. But in some cases, if your turnover of business is more than 10 crore, then only you are liable for audit. 10 crore limit is applicable for whom? When the cash receipt is up to 5% of total receipt and your cash payment is also up to 5% of total payment. Okay, then only you are liable for what? That 10 crore limit. Otherwise, you are not liable for that 10 crore limit. Let's see the cash receipt of this particular firm. The cash receipt, the turnover is 2 crore 78 lakhs. So if the turnover of 1 crore limit is applicable, then this firm is liable for audit. But let's see whether the cash receipt and cash payment is up to 5% or not. Now the cash receipt is how much? This is not the cash receipt. The cash receipt is this one. This is the total cash receipt. The cash receipt is 19 crore and the total receipt is 4 crore 56 lakhs. Therefore, 19 divided by 456 come to 4.16. So the cash receipt is less than 5%. Okay, it is up to 5%. And the cash payment is 3.8 lakhs and the total payment is 2 crore 38 lakhs. Therefore, 3.8 lakh divided by 238 lakh, this is 1.597. Therefore, both payment and both receipts are up to 5% of total receipts. Therefore, it will not be liable for what? Tax audit up to 10 crore rupees. So this is what this question is all about. Okay. Next one is also a similar question we have already done. So majority of this MTP paper was already done by us. Okay. So this is what this 8 MTP is all about, completely in full English for my dearest students of South India. Okay. So this is what I have done it for my dearest South Indian students. 8 RTPs, 7 MTPs and 8 mock test paper. Total 23 papers. As a student, you cannot imagine to revise even 5 papers a day before examination. 5 papers is also an upper limit if a student decide to revise itself. But we have tried to achieve the unachievable over here. Okay, we have tried to do something which was impossible. When I thought of this idea, even I was not aware that how I am going to do that. But your motivation has helped me. Your consistent pushing every time I put a video in Hindi, you guys tell me, please put in English, please put in English. That put a lot of pressure on me. That helps me to record separately a video in English. I hope you all have enjoyed this video. And I have only one sincere request, 2 requests, which I guess you will fulfill. If you have liked this video, please comment your views below. And if you have liked this video, please share this with most of the students who wants to learn direct tax in English in the finest way possible in this entire country. Okay. Till then, all of you take care. Bye all of you. See you soon with more videos. Bye.